What's going on, team? How we doing? We got another great show for you today. We're going to keep it going after all access. We're going to get you guys into some education session. Like always, we want to give you guys some strategy, some way to give back. Well, today we're going to replay from a boot camp in June, a moment that I truly appreciated where Anne-Marie Ban runs us through, of course, how to really stop losing. So we're going to take a look into this boot camp edition. And like always, one of the things that we want to do is give back to you. Normally, we take these boot camps off. So what we're going to do is we're going to start giving them back to you so you guys can enjoy them here and keep upping your skills. So give me a thumbs up if you guys are excited about this. We're about to get right to it. Looks like the SPY is battling, so I can take a quick look into the market here, and then we'll get right towards our educational stream that's going to get started here. The SPY battling here, bounced around the 395 area, and then I started taking a bet towards the upside. I got in there at 395.06. We're going to look to see if we can get it back towards 396, sell most of it there, and then look for an extension above. We'll see what happens here on the SPY. It's been battling the pullback. Of course, it hasn't been the best day. We have gotten some pullbacks on some stocks. Utility's been doing well. Healthcare doing well today. So we'll get into some stocks like always, but let's get into some education. How we doing out there, team? Let's get right to it. It's good to see you, Ivy. Good to see you in the chat. Let's get right towards some education now. I'm going to go ahead and pull this down. We'll take a look at the stocks. And of course, we got what we're going to do now is we'll give you that education. And then after that, we got, of course, a boot camp. After the boot camp education, we got Benzinga Live and, of course, stock market movers after that. Sorry about that. I was getting a little bit of an echo in my ear. It was confusing me there. But let's get right towards this education here. I'm going to pull down my screens. We'll see what happens, of course, in the markets. It's been battling to come back. Let's see what happens and what I can tell you guys at stock market movers. Of course, you guys will get Benzinga Live at 11:45 starting today. But let's get you to this education here. And you guys let me know how you guys can hear it, and I'll get it started right now. All right, let me put it up here. Get those hands going. Instead of that, grab a pencil, grab a pen. I've talked about it earlier today. Pull out the notepad.
All right, let's get it going.
I'll write on notepads all day. But it's all about getting lessons that you guys can learn here to benefit yourself. There's always a strength that every speaker coming on has that you guys can be using to benefit your knowledge out there. And this is what I always look for whenever I'm hearing interviews, wherever I'm hearing a speaker. I'm looking for the strengths that they have so that I can go ahead and learn from those strengths and hopefully bring it into my toolbox. All right, team, we're about to get into an education stream. I see you guys hanging out here. We did take a look into the markets. Markets are bouncing a little bit. We'll take a look if they get that full bounce, of course, on Benzinga Live and stock market movers that will be coming to you at 11:45 for Benzinga Live and, of course, 1 p.m. for stock market movers. I'm going to get into some education here for you guys. This is from our June boot camp, but trust me, this skill is very much needed in this style market. Anne-Marie Ban is going to come in here and give you guys a great tip. I'm going to get it started, and I'll see you guys in a little bit. AB will be on, and then, of course, I'll be ready with stock market movers. So let's go here. Let's bring on Chapter 8, Limit Drawdowns and portfolio and build your portfolio size, the money ball market approach. Let's bring on Anne-Marie Ban here, author and financial analyst and educator. And definitely, guys, check out thetradingbook.com. Let's bring her on.
Let's do it.
All right. Is that
hey, guys. Hey, guys. How are you today?
Ready to kill it. Let's use this screen. I like this one right here. Hey, you got AB and Money Mitch on your sides, and we're ready to learn from you. So you're gonna do one of these. Just push us off to the side. Just give us a little push. Boom. What?
Hi, everybody. Thank you so much for having me here. We are looking at the Benzinga Pro tool. I thought this would be a great way for us to look in the markets and figure out where we're going, what we're doing, and employ something that we've been using in the Benzinga Pro platform called the Moneyball market approach. And so for those of us that are sports fans, Moneyball is, you know what it is. For those of us that aren't, the term comes from finding the highest probability of scoring a run if you're a baseball player. And so obviously baseball has a lot of statistics. It actually is my favorite sport. I love to watch it because there's a lot going on that's below the surface. And so what we've decided to do here with Moneyball is say, where can we position ourselves statistically so we aren't going for the home runs every day or every week, but we are positioning ourselves in a way that most of the time we are making money. And so what that means is we're going to use an options approach in a very specific way. And you can actually see if you go to the Benzinga Pro, you can see that there's something that says Anne Marie Band Trades. And Mitch, I'm so happy that you pronounced my name right. That's the bane of my existence. I should have it legally changed, scratch out some of those extra letters so it doesn't happen, but super glad. And I
I'm
thank you
trying.
very,
I'm
very much.
trying.
Yeah,
You definitely
good job.
deserve it. You definitely
Good
deserve it.
job.
So we got to work on that. We got to work
Yeah,
on it.
good
Hey,
job.
you guys
All right.
take notes, man. I'm loving this. Ready to see you knock it out the ballpark. Let's go.
All right. So the way that we find out statistically how we look at things, we're actually going to peek at the latest trade that we've put into this formation, and it's with the USO. So the first thing I'm going to do is open up the chart that I look at every day I come into view. I take a look at this particular set of formations to tell me, all right, what is the broad motion and what's the broad approach? So the two things that I really want to know is, am I trading with the trend or against the trend when I position my trade? And how much do I have at risk? So the key event, when you look at something called expected outcome, that means if I did the same thing over and over and over and over and over again, thousands of times, would the end result be something positive or would it be something negative? And we are building an approach like that for something positive. And so here's what we're looking at. The USO is very big on my radar right now, not because I normally love to use it. I think it's a poor structural example of what's actually happening with oil. And the reason for that is really a tonfold, but we don't want to talk about that at this juncture, except to say that right now it's going to be one of the better choices that we have overall. And so here's what we're looking at. The first thing I look at to tell me about where price is I will actually look at a candlestick that covers an entire year. Okay. One candlestick equals an entire year of motion. And what you'll notice is in 2020, we had this savage downward move, demand destruction, right? This was the COVID business. And then 21, and here we are in 2022. Now, ultimately, I do believe that prices head higher over the longer term, but right now, I think we're going to stall. And the reason I think we're going to stall, I'll explain later, but I'll go from a yearly chart to a quarterly chart and I'll say, okay, what happened at the last quarter, which is this one right here. So I'm looking for the high of the last quarter and then the close of the last quarter. And I'll notice something very interesting. Yes, I did make a higher high, But now I'm under the high of the last quarter, and I'm looking for this motion underneath here, right around that 82 position, for price action to come in and potentially stabilize. If it doesn't, it's going to give back a little bit more, and it's probably going to come in somewhere around the 78 to 76 area. Now, the big question might be, but Anne-Marie, this is really the only sector that is moving straight up besides soft commodities like grains and that sort of stuff that you can eat. Everything else has had a fade. So why would I think about shorting something in this environment? And so the quarterly chart gives us a tiny clue. And what we want to do is confirm over the range of motion. So back here, 2020, we have high and then a low and then a lower high and a lower low. Could this be a lower high? Potentially, it could be a lower high. It could also end up just giving us a space where we want to move to the top and continue forward. So one of the things we have to manage is risk. And so we have the two pieces. One, I think there's going to be a little bit of a pullback. Two reasons, actually three reasons I think there's going to be a pullback. One, WTI and Brent on the futures, where they actually work with the physical commodity of oil. They are in something called backwardation. That means if you go out into the future, the price they are commanding for a barrel of oil is less than it is today. That's not normally the way things would sort of look. The second thing is a lot of the narrative, and you really have to see what people are saying, because big money is always going to talk their book. They just are going to. They're going to talk about what's best for their positions and their clients. And so you'll hear a little bit of that, and they're all saying, hey, oil is too high. Three, we have a mid-cycle election coming, and I suspect that we're going to hear something very interesting coming out about Ukraine and maybe things getting a little bit flatter there. We just got a piece of news that said South Africa was still considering buying Russian oil. That's going to put more Russian oil on the market. That's going to potentially give us a little bit of slack in that formation. And then the very last and most intricate one, we have quite a bit of pressure on financial assets, meaning everything that we look at in the stock market, right? We can't take a share of Apple and go to the grocery and buy something. We have to convert that share into dollars and take those dollars and go to the market. So what that means is if somebody gets a margin call or they start getting nervous, whatever it is, people are going to sell into the financial asset to pull cash out and do whatever they need to, whether it's a margin call or they feel they need to raise cash or whatever. And though USO is modeling somewhat of a physical asset, it's, oil producers coming out of the ground, it's not actually a physical asset, it's a financial asset. And so you're going to see that strange disconnect, because at any point in time, people have to sell this in dollars before they can take the money out. It doesn't really matter that it's not, or models a physical asset. All right. So we see that in the quarterly formation, we've got a little bit of trouble. From the monthly formation, everything looks great, except for the fact, again, that we are below the high of the month. And then for the week, we've had high, low, higher high, higher low. First one, lower high, lower low. And we're coming into test. Here's a gap event that really hasn't been tested in times past. It could come in and just move a little bit sideways, because overall I am very bullish on the sector of energy, right? I ultimately believe it's going to stay higher than lower from an elevated sense. So you might go, good grief, Anne-Marie, that's a lot to put into a trade. Well, here's what I want to tell you. Right now, preserving capital should be the most important thing that you think about on a day-to-day basis. You should be thinking to yourself, wait a second, is it better that I am less invested when the market seems to be telling me all kinds of different things than more invested? And if you look at any graybeard out there or folks who've been trading for a really long time, you're going to find out that we all share one thing in common. We know when it's the right time to say, you know what, I need to be less active rather than more active in the market. And so our position sizes are somewhat smaller. So what's the takeaway from this? Whether you are looking for a swing trade or a day trade, it's very important to look over the big picture to tell you what's happening. And as it sits, we are above the moving average. This is a 5. I like using it because it's tight, and I don't use it on super tight time frames because it can get very noisy. But I use the 5, and I can see even all the way down from the quarterly perspective, I am above an upward moving average. I'm above an upward moving average. I'm above an upward moving average. Only here on the daily can I say, wait a second, all of a sudden I'm not above it. So what I'm doing naturally is trying to flesh out support. And so this is the trade that I have put together. Now, how does a Moneyball trade differ from any other trade? Well, the first thing I want to do is try to use somebody else's money. And so you might say, what is that? Anytime we sell an option, we are using somebody else's money. And so in the market, if you sell an option, you collect money into your portfolio, and you can use that cash to open up other positions or to limit the exposure you have in a position. Okay, so that's the first thing I want to show you from this perspective. A lot of times seeing things up close a little bit hard. So I'm going to try and pop these things out for us. Here we are on the Benzinga site. And so the Benzinga Pro platform has the trade. It came in this morning at 10:43, and I opened a position in the USO. Very straightforward position. This is called a vertical spread. It's where I buy an option and then I sell another option to help me pay for the option I just bought. And you can do it at the same time. So that's really, really great. Let me open up Thinkorswim here, and we're going to go to the USO. And you're going to see, if you've got a good screen, well, you're probably not going to see what that is. Do we have, no, we don't. All right, so what I'm going to do is I'm going to take a little snapshot of this. And I'm going to expand it. I'm going to show you what the trade looks like. All right. So here we go. And where should it open up here for me? Ah, there we are. 2 secs. Got a couple of screens I'm working with. USO. All right. And then we will open this up and shut that down. Slowly but surely. Here it goes. Oh my word. Sure. We'll use photos. I don't know why it did that for me. Ah, there we go. Okay, so what I'm going to do is expand this, and you're going to be able to see that I bought the 82 puts and I sold the 78 puts. I only paid 87 cents for it. It's going at 90. But if I were to just buy the 82 puts, the price would be much more. And I'm looking for July. And so if I bought the 82 puts, it would be $2.20. You can't see it, but that's what it says, 220. Instead, I've got exposure to this position for only 90 cents. So in the market, there's always a give and take. And the give and take is always associated with risk and reward. So if I had just bought this 84, this 82, that's 220, $2.20, that's $220. If I had just bought it outright, and let's say the price went to $80, I would not make any money, because $82 minus $80 is $2, and I already paid $2.20 for this one. That's if I waited all the way to expiration. Now, there's a beautiful thing that options do when you're sitting in a space and you're using somebody else's money and you don't care about holding it to expiration. And what happens in a very volatile, whippy environment is options increase in price even as we move along. And so irrespective, as long as it's fading, we are going to make money in this as long as it's moving towards even that 82. Because what I'm really looking for is just $1.65. I'm looking to watch the price action come into that 82, and then I want to see the actual price that I've paid move from 87 to 165, and that gives me 100% profit. And so there's my Moneyball event as it goes right there. So what is the risk? And the great thing is we always have this risk set up here. I always tell you where my stop is. These are always my trades. So it's an introductory position because I don't really know if it's going to go all the way, but I want some exposure into the group. If it absolutely savagely moves, we'll make a ton of cash. If it warbles around and allows us to add in, we'll be doing even better because our size will multiply and we'll have that from a space. So what is the takeaway there? One, market volatility in the current space makes where we set a stop very, very important. The sad thing is, if we set the stop too tight, we die death by 1,000 cuts. And if we set it too wide, then we sit with a really big loss. And so what the Moneyball approach says is use somebody else's money and lever your approach based on what the big formations are saying. And so it would be sort of, I don't want to get too big in the weeds from baseball analogy, so I won't go there. It's sort of like saying, hey, listen, here's a guy. He's got 2 really good pitches and 1 pitch that's okay, but he has trouble finding the plate when he needs to. You just want him to stick with those 2, right? Now, people who are, do we do any polls here? Can we do a poll or asking questions by getting someone to answer? How many of us have options experience where we could sort of look at something and go, oh, okay, I see what's happening there. So that would mean in the money, out of the money, that kind of stuff. How many of us are sitting in that camp? And I'll know what to do from there. If there are only a few of us, that's fine. If there are a lot of us, then that's great. One of the things that I want to tell you is that you can do things like this. We've got this out in the future. The further out into the future, the less sensitivity you have, the more forgiving your option price is for you. The closer you are to expiration, the more sensitive it is, but the less forgiving. And see, that's the thing. It's always a give and take. And many of us who trade in the option space, we've been around a long time and we understand this give and take really being something that we learn about over time. And so I was talking with someone about this particular position, and they said to me, well, why don't you buy something deep in the money if you expect it to go down? And so here's what I mean by that. Could you say to yourself, hey, I don't want to trade out here. I want to get a sure thing. Really, no such thing as a sure thing. But the deeper you go into the money of an option, the closer the delta gets to 1. Okay. And so delta, the definition of delta is actually how much an option will move every time a stock moves $1. So let me expand this again. I'm going to take another picture. That's going to make it nice and easy for us, simply because it's easier to do that than try to make you lose your eyesight taking a look at these things. So we'll look at July. And one of the reasons I'm going through these sorts of things is because there are a lot of ways, I mean, a lot of ways to trade. Heavens, I want a snapshot. Not giving it to me, for heaven's sakes. Ah, good, it did give it to me. So one of the reasons that you want to do something like taking a look at the Moneyball approach is that you really need to be super focused on how much do I have at risk. Now, for those of us who've been in the market only a few years, this notion of risk is not something that you're used to. And the reason that you're not used to it is because the markets have not really been going down. They just go up. And for about 1.5 years, every single fade has been bought, so much so that we think that, hey, don't worry about it. It's going to reward me. And this is something that's very, very new to us. I mean, really new to us. And I want you to realize that it's not always like that. The markets sit in places right now where it could very easily roll over. I mean, very, very easily roll over. So let's take a look at this picture again, and I'm going to expand it so you can take a look at this, understanding these chains, and then we're going to go back to tighter time frames, and we're going to see what we're looking for. Question, Mitch?
No, I
Yes?
just wanted to jump in and give you a little update
Yeah.
on the poll. We
Yes.
do have a poll out there. I asked if you had experience trading options. Is it more like a few months or multiple years? And I am experienced. We got a few months. So it looks like a lot of
Okay.
beginners on out there in the
Thank you.
option game.
All right. That's perfect. Wow, this is cutting the top of my head off. All right. So here's what I want you to look at. In the option chain, in times past, what's happened to us, because things have been running to the north, we've been very accustomed to saying, hey, listen, I'm just going to go buy the deep out of the money call and everything's going to go right for me. So now, if you look over here, people are still thinking that. See this number right here? It says 42,798. That is something called open interest. And open interest is how many contracts are long in this environment. Now, long means you buy it thinking price action is going to go higher. Well, there's 42,000 of them in the month of July that say, hey, we're going to 95. So there are a lot of people thinking that prices are still going to move up. Because the market has changed, what's really happening isn't that at all. And as newer traders, we can't look at going deep outside of the money, spending $1.60 or $160 per contract, thinking that, hey, listen, this is going to be $4, $5, $8, $9, $10, and I'm going to make a ton of money. That's not the environment we're sitting in anymore. And so what we have to look at is what's going on the other side of that formation if indeed prices move in another direction. Now, here's the thing. If you go and buy this at the 95 strike because you go, you know what, 42,000 contracts can't be wrong. I'm going to buy this call right here at $1.60. That's perfectly fine. What you have to do is manage your risk. And so since this is July and it's 160, the spread, that means if I were to buy it and then turn right around and sell it, how much money would I lose? That's what a spread means. If I sell it and then have to buy it back, same sort of thing. It's about 17 cents here in this environment. And so you lose $17 if you buy it and immediately sell it. Now, this is not a horrific spread, but it does matter. And so you want to be careful about where your risk sits. And so I say, if you use an option straight out like this, you want to really think about a 50 to 60% loss to give yourself a shot at the price action being noisy and then stabilizing at the end. So that's really what you want to be cautious of. For me, I've thought, hey, price action is going to start moving in this direction, meaning it's going to start coming into a support zone. So I'm really looking for it to move from 82, the price it is at 82, to the price that it is at 86. So I'm really looking for that motion for about $1.50. Now, don't get confused. I have a spread that I only paid 87 cents for, but I'm saying if you went outright and you said, hey, I'm buying this outright, my stop is going to be, let's say it's 50% for ease of calculation. So my stop's going to be like $1.08, right? Maybe I leave it at $1. So that's $1 that I would lose from that perspective. But if I buy my spread, I have much less exposure, even though it's bounded, right? At 78, I have much less threat exposure for what I lose. And the key thing about Moneyball is I do not want to put myself in a position where I'm losing. Now, during the time we just started chatting, that option spread has gone from 87 or 89 all the way up to 96. So it's moving in these 10% motions. So this could easily come into our target tomorrow if we have price action. So the key event for a Moneyball trade like this is one, I have time, and two, I have enough sensitivity that it's not so far away that it's quiet and doesn't give me what I want, and not too sensitive that if it bounces up and down, I'll get stopped out of the trade. All right, so now let's get back to the charts. And I want to share with you, wow, take a look. Look at that. Markets continue to move up. Boy, people who think that 75 basis points are going to push the market down, they're getting their heads handed to them. Holy moly, this market is, wow, it's something. But look at what's happening with our trade, right? Markets moving up for us in general. We've got oil, this USO, stationary to relatively down. Here's a piece of advice I want to give you. When you're trading, try not to stare down your markets. Figure out a premise that holds on a bigger time frame, and then watch for your supports and resistances. So coming into this Fed approach, we've been really sort of hedged in very, very specific ways. We've been hedged. But the big takeaway is when the market is very sideways like this, you have to think about being on the edges and making a decision. And if we'll go back to this, I don't have the VWAP sitting in a really big place here on my Outlook. Which one do I want? Outlook. All right, I don't really have the VWAP sitting here as I potentially should, but I'm going to expand it out and I'm going to share with you something that is super important, and it's going to be for SPY and the Qs and whatever else you happen to choose. All right, so this is Amazon, right? I am really looking for Amazon to come into maybe, I'd really like for it to sit somewhere around the 106 to 105 area. We've got something called a butterfly. And again, why would I pick something with such a strange name? I want to make sure that I'm using somebody else's money to position myself in the best place that I can be. And that really is what you're going to see. So for those of us that know calls outright or pulls outright, puts outright, we add one more piece to the puzzle, and that involves somebody else's money coming into the mix. And so that's really where we get to sell options to benefit us in the long run. Now, you might say, well, why would I want to limit my upside or my ability to profit sizably? Well, here's something very important. And we're going to use SPY to show you this. What I'm doing today, folks, is expressing to you something that's way more fundamental than I've ever done in a boot camp. And the reason that is the case is because we're in a different market than we have been in times past. And I've been doing boot camps for years. Those of you that know me, I've been doing them for years. And so until about the beginning of this year, we really have had buy every pullback in the event. And then something really important happened. We began to close underneath this 5-weekly moving average. So here's what I want you to put in your notebook. Am I under the weekly moving average, or am I above it? Is that moving average flat, or does it have slope? And so those are the things you want. Am I above it or below it? Is it flat, or does it have slope? Those things you want to know. Once you answer that, you might immediately come to this and go, hey, what's going on here? It's flat and I'm above it. Then you should be at the space where you go, where's the last time that I went from above it to below it? And it shows you right here. And wouldn't you know it, That's where the SPY top ticked. If you want to use something like Amazon or any chart that you want, anything, you do the same thing. Am I above it or below it? This is sort of flat, so we know it's sideways, but let's say you don't. You're like, hey, I'm above it. Okay, great. That means I'm going long. When is the very last place that I was above it or broke below it? Next to this one, you can go to this one right here, or you can go to this one, right? That's the real breakdown. It's either up here or right around here. For the last time, hey, I ticked it, it was downside, I moved above it, and then I moved below it. Use your eyeballs for the chart to tell you what's happening. Those are going to be the best things for you. Just use your eyes and say, does that make sense? This top ticking tells us, hey, I'm above this 5, but I'm running out of steam, right? And so what we have is this market in the current environment that really is saying, listen, I am moving a little bit above and then I'm crashing below, or I'm just moving sideways and then I'm crashing below. So you're not looking for any big upside pressure events to just take you to the promised land. That is not the current environment. We are in a huge repricing of assets. And so when we reprice, we have to think about what's that future event telling us from a broad perspective. Okay, here we are on the week. I'm going to delete all these lines. And so when you're looking at something like this and you see, oh my goodness, I have a gap down, you know there's possibility for a bounce. But what is the slope of this moving average? It's down. So anytime you hit that downward average, look to the left and see where it was the last time it tested that event. So here, this is the closest one it got to, right over here. And you can see that the bounce is nowhere near that high. It's actually closer to the bottom, which gives us more risk to downside pressure. Take a look at this. This line is the monthly open. And we've come into the month and just keep collapsing. Here was our monthly open in between these ledges. And we faded here and we faded here. And now here we are into the third week, options expiry week, and we're sitting downwards. Okay, so there is much more action here that gives us this downside pressure event. Now, you might be saying, yeah, but I'm only looking for upside because I only like to go long. Here's what I want to tell you. When you are looking at things from this Moneyball approach, you have to think of what is the broad market telling me about price. And so the broad market is telling us I'm in a down cycle. I've been far away from that down cycle, so I might be bouncing into it. That's not an illegitimate thought. So you can look to the left and go, hey, I might actually bounce to 385. I might actually have a bounce. Okay. The one thing you can look at is, am I headed lower? Day before yesterday, lower high, lower low. Yesterday, lower high, lower low. Today, higher low, higher high. So that breaks the pattern and it tells you the traders are trying to bottom pick the market. But in a bottom picking event, we're going to go two places: into the last area of known resistance or into some area other than the last area of known resistance. And when we do that, we're looking at things that tell us we've got to be very careful about exposure. Now, for those of us who have funded accounts or trade in areas where we have a portfolio manager behind us. Not sure there are many of us, but there might be a couple of us that do. Some of us are not allowed to trade during the Fed release, and my goodness, isn't that a good reason why? Now, I don't know what Powell is saying, but whatever he's saying, the market is feeling a bit bullish about it. Okay, so what's the FOMC done in the last 4 cycles of releases this year? This is also important for you to know. Again, another fundamental thing. This is why you use the Benzinga Pro platform, because it tells you, hey, listen, the FOMC is coming, they're doing this. Every cycle event we've had this year, we've bounced and then faded. So my hope is, yeah, let's get a really nice bounce and then let's continue on with the fade, right? If you look at the VWAP, and I love looking at the VWAP, that's volume weighted average price. It literally tells you, in general, if we are printing prices above an upward VWAP, everybody that's participated during the day that is long is above water. If we're sitting below that VWAP, it means everybody's underwater. So what's the trade? Well, you always want to run with the slope of that VWAP. The slope of that VWAP will tell you what it is that's most likely to happen. And listen, I am a very simple trader. I look for old resistance and new support to think about trading. Now, I did not put any positions on here. One, the options are expiring today, and that will make them very volatile. Two, this will be Wednesday options. Two, we're in the middle of a cycle event that might be dramatically bearish or dramatically bullish, and so volatility could spike or collapse. And three, because of that, I'm interested in waiting to see what that bigger picture tells me. But as easy as it looks, all you have to do is not second guess yourself. So I have the 5 simple moving average up there. I have the VWAP up there, and I will look at the beginning of the day for the VWAP whenever it starts printing to where it is currently, and I'm going to say, is that moving up or down? If it's moving up, I'm going to go, where is old resistance? Where is new support? And I'm going to engage. If I want to engage intraday, I'm going to engage right there. And I like using that hourly time frame because it gives me a shot at saying, hang on, let's see where I can go from support to resistance in a way that is straightforward and doesn't leave me wondering what's going to happen to my option in the space. So what I'd like to do is sort of open it up for questions. I know I'm almost at the end. I ramble constantly. Mitch, if you wouldn't mind coming on and helping me with some questions, maybe some that you think that the traders might want to explore on their own, or anything maybe that I wasn't completely straightforward on. And then, of course, folks, if you want to find me, I'm on the Benzinga profile. I'm on the Benzinga Pro platform every day. And you can come in and see me there. I share information about what's going on from sector events overall, what's overbought, what's oversold. There's a Moneyball morning event that tells you what to look for with your charts. So I'm there, and I'm there sharing many of the trades that I do feel are important for us to structurally follow. I do have a lot of complex trades, but I do not put those in that Moneyball event. It's usually, super straightforward. You can also take a look on the, oh, look, Mitch and I. look at the ideas, which is a beta tab, and move it into your platform, and you'll see that I give you how I open the position, why I'm thinking about it, and what it is. Buy to open, sell to open, stop and target. And so I try very hard to make that something that we can all learn about on that step-by-step space. Let me see if I can find. Mitch went silent. He went dark on me. Oh my goodness.
I'm always here. I'm always here.
You know what? Let me see if I can go to the YouTube.
This is what happens when I'm watching in the back and I'm muted and I'm like, man, what's going on? How we doing, team out there? We're about to get Benzinga Live started in just a few minutes, so stick around. We're showing you guys a little footage from the Benzinga Boot Camp in June 22. And definitely just want to let you guys know, you guys can check out the trading school. Threw up the link there in the comments so you guys could check it out. And definitely, you guys, come over and check it out. There you go. She's pulling up the questions there. You see? Anne-Marie Band doesn't need me.
Right. So
honestly, Anne-Marie Band, the way that she explained things, she has a calming voice.
Really see if you guys want to ask any questions on the YouTube chat. Oh, do you want to look at Netflix? Folks, if you want to think about a trade that is really, I think Netflix is going to have a tough time. So let's go here.
All right, I'll let her go through this Netflix trade, and then by the time she's done with that, I'll be getting on Benzinga Live started just in a few moments. Definitely smash the thumbs up. Yes, this is a recording, and
we get a trade
what it is that we normally pull this off, but we're bringing it back to you guys.
Massive
so you get
gap down,
to
earnings gap. They've got a lot of debt, and so let's go to a monthly chart. If we take a look at this monthly formation, Netflix has just absolutely collapsed. And so, interestingly enough, if Netflix has any kind of major bounce, it's going to be a sell. It absolutely is going to be a sell. They are not going to be able to command presence, as in eyeballs, the way they used to, because there simply are too many pieces of competition, right? And everybody wants that. So again, how do we look at that? How might we position here? Oh, there you are.
I'm here. I was doing a little bit of double duty, and we were also listening in to Pal. You know how Pal can sometimes take attention away.
Absolutely.
But I've been listening to a little bit of that VWAP talk. I saw some options being mentioned. You covered it all here.
I did. I wanted to give us, here's the thing about Moneyball. Moneyball really means that you take a composite look at what the market gives you. And it's necessary because we're not in shooting fish in a barrel environments anymore. When the market was going straight up, it was super easy to buy anything and get yourself some alpha from it. Now it's all about positioning with risk. And so, although this feels like it might be a little bit heady, what I want to let you take away is that looking at price action from a composite space, right? Looking at this thing in Netflix, right? We've got the weekly into the next earnings event. Do you actually think they're going to go, you know what? It's great. We've got a bunch more subscribers than we had last time? It's going to be no, because the competition continues to ramp up against Netflix. And so they they are not going to be able to command it. My thought is a really interesting position would be watching and seeing if you want to go flat out short. I would say the better bet would be to wait for the bounce. I think there's a bounce coming. You can see that little arrow it shows. I'm waiting for it to try to recover, but this chart is going to go down, and I would not be surprised if it's half this price a year from now.
Yeah. So one thing that I always look at, and what I think you're mentioning there also, is not only the technical side, but also the story of the stock. And so one of the things that I always talk
Exactly.
about is knowing, I call it the three variables. I want to know the story, the catalysts that are coming out. What is the future outlook? Is there anything that they can innovate into? That's going to go into the story. And then I like call the second factor, I look at the fundamentals. I look to see if there's anything there. Does the price to earnings make sense? Are we talking price to book? Do we kind of see maybe analysts in this area talking about an upside at streaming? And that can definitely change around the fundamental outlook. And then, of course, what you're showing here, that what I think is the gold, the technicals. And once you can do all three, I feel like you can have higher conviction in those trades. And then really, I love the approach in Netflix and always not trying to get too far. If you miss the move, always remembering that another opportunity can come.
Exactly. And if you're looking at the big pictures, you're always going to see that there's never only one shot to get in.
100%. And then really, when you look at that big picture, that you're like, man, I did give another opportunity. So don't. Sometimes I think it's important also to leave out like further out alerts, like when you're like, okay, well, I might have missed this huge drop on this stock, but I'm gonna set a level, and if it could come back up to this level, that's when I'll go ahead and take my reanalysis approach, and then you'll be able to find some trades and just alert yourself on a major level that you're looking for the stock to either break down through or get back up to that level. So then you can go ahead and make an investment decision when it gets to those levels versus, getting in a whole bunch of shakedown. And that can happen.
Exactly. Exactly. And the last piece of that is really learning to develop patience, because we always have that piece of us that says, "Oh my gosh, what if I miss out? What if I miss out? What if this is the space and I miss out?" And I'm going to be completely transparent with you. That happens to me almost every day. But what I have to do is say, "Okay, hang on. If I do it now, what's the risk?" And if
Oh,
you focus on that and you go, "Okay, well, maybe I'll just put a tiny position in," that would be way better than going, "Oh no, I'm just gonna," because some folks go, "Yeah, but what if I put a tiny position in and it moves all the way up to XYZ?" Well, see, we're not in that kind of environment. We're in a very choppy space. Look at Netflix. Look at how many weeks it's tested the exact same price. One, two, three, four, five, six, seven. Coming up on 8 weeks, if it bounces into this area at about 190, 190, yeah, it's tested that for weeks and weeks and weeks and weeks. So take a breath and go, "It's okay. I don't have to rush this trade. Where can I get in where I'm going to have the least risk and the most reward? And if it leaves me in the dust without being there, can I come back and make it happen?"
probability, guys. The money ball market approach here. Thank you for having us today, Anne Marie Ban.
Thanks for
You killed it
hosting,
like
Mitch.
always. And definitely, I always say keep the mathematical advantage in your favor if you guys want to have a system
Exactly.
to keep coming at it.
Exactly.
Thank you, like
Exactly.
always. All right, I'm gonna
Thanks,
bring you
Mitch.
down, and we'll have you back, guys. Check it on out, and also if you have Benzinga Pro, check out that trade ideas, and also her chat room for her trade ideas, so that you guys can catch these great trades. Thank you, Ann. We'll have you back.
Take it there. Thanks, Mitch. Bye.
All right, let's go ahead. I'm going to bring on. All right, pulling this down here. AB is about to get started on Benzinga Live, so you guys get ready to catch Benzinga Live. I'm going to be paying attention to the market, getting ready for stock market movers. You guys tune in then. That's going to be at 1 p.m. Now it's time for my man AB to join us. Let me know when he's ready. Looks like he's enjoying a good salad over there. I don't know who eats salad anymore, but I can't eat salads, man. Come on, man. I need some of that good stuff. But, I'm not watching the weight here. We'll see if he's ready to go in just a few seconds. He should be joining me. I'm taking a look at the market out there. Looks like utilities are actually still doing well here. We'll see if that turns around. It's been getting a nice little boost there. It's up there today. Some of those utilities, healthcare is doing well. Communication services, downside, consumer cyclical, technology, and real estate. We're going to see if the SPY is able to turn around. It's been heavy all day. Tried to get back towards 396. Went to 395.99 and then turned around there. So we're going to see if it's able to hold the pullbacks now and then get right back up. It is dragging right now. Definitely if it takes out around 394.50s, I'd be a little bit concerned. But we're right there now. We'll see what happens on the day. Time to bring you guys into Benzinga Live. All right, AB's going to jump in here and take over here. You ready? He's ready, guys. Who's ready for a little bit of Benzinga Live action coming to you, AB? Let's go.
This is Benzinga Live. Spencer Israel and producer AB. What's up, everybody? How we doing?
Someone told me buy high, sell higher. So.
Let's get Matt Hammond on the show to talk some IPOs. Jake Wojasek from Trend Spider. We have a breaking news.
What is up, everybody? Happy Friday. We've made it through another week. Welcome back to Benzinga Live. VIX go to Benzinga. What does that mean? I don't know, but we'll talk about the VIX today. We'll talk about what the market's doing. We'll talk about my trades, my options trades that I'm in right now. We'll, of course, do a check back in on the wealth base challenge, see who's leading there. I don't think I'm doing too hot right there right now. I got caught in some longs. I did, and at 12:30 p.m. Eastern here in about 45 minutes, we'll be having Eric at ES Invests on from Twitter. We're going to be talking some options trades with Eric. If that's your first time with us when we're talking to Eric, he's super knowledgeable when it comes to just different ways to trade volatility, go long, go short volatility. You blew by me in fantasy up 200 spots. All right, well, let's start there then, Jay. If you want to start there, that's fine. We can start with the challenge. Like I said, I'm not doing too hot. I'm in about 50th place right now, or not 50th. I'm in the 50th percentile. I'm about halfway up the leaderboard. Here, let's get the screen shared here. Boom. All right, guys. Whoa, look at Luke Pursuto, Mike Wazowski, up 26% since we started the challenge. I might need Luke here to start doing my my real portfolio. I don't think that's Hot Stocks Luke, but he's gunning for Hot Stocks Luke. He's trying to take that name from them. I'm in 222nd place right here, so not great by me right now. I don't even know what's in my portfolio right now. Oh, it's because I chased Baba. So, okay. I made a bunch of money on Baba on this, not in real life, but on here. And then I chased it because I sold it after I went up, and then it was up another 8% yesterday. I bought some, now it's down. All right, so my meta is slightly negative. So everything's down today. I need a rally in the real market, in the real market too. So let's go to our Benzinga Pro. Let's check in on the overall indices, see what we're doing right now. The S&P 500 trading up, but barely, just about 2/10%. Go to a 5-minute chart here. You can see sold off after the open here and trying to make up come back up a little bit. Looked a little double toppy, so it doesn't look like great action intraday. But if we can kind of start coming back up here, then what I'd be watching if we can clear where we opened at, kind of clear this 397 level, 398 level, and then of course I think 400 will be that big kind of psychological level. We did get above 400 briefly the other day. Where was that? Didn't we? Yeah, right here. Intraday, we got up to 402.31. What was that? November 15th? That was on like Tuesday or Monday of this week. But I want to see us take out that 400 level. I'm not saying I don't think it's going to happen today, but maybe later next week. Of course, we're going to have a shortened trading week. So next week, those Q puts paying off. Woo! Shout out Straight Challenger, J Dot, for getting in on some Q puts, making some money on them. But next week, let's go through the schedule real quick. So Wednesday, actually, I want to double check this. I believe Wednesday, market hours as planned, just normal market hours, 9:30 a.m. Eastern to 1 p.m. Eastern. And then Thursday, the market will be completely closed for Thanksgiving. No stock trading. You can trade some crypto if you want, but I'm just going to be watching some football, some Lions versus Bills, eating with family, not worrying about trading on Thanksgiving. And then Friday, Black Friday, it will be a half day for the stock market. So Wednesday, hours as normal. Thursday, stock market closed. Friday, it will be a half day. I do want to check in on Bitcoin. Speaking of, we're talking about, being able to trade crypto over Thanksgiving when the stock market's closed. So I'm not, we can go to a weekly chart here too. I'm not touching Bitcoin here yet at these levels. I mean, just looking at the chart, it looks like certainly we're gonna come back down. Not certainly we're gonna come back down, but the chart indicates that to me it looks like we're heading down toward more the 13,000 level. But at some point, I wouldn't be opposed to buying Bitcoin, not to buy and hold, because you guys know how I feel about crypto in general. I'm not really a big fan of the industry, of its lack of economic purpose. I think it's a net loss when it comes down to it. But the Bitcoin, I could be talked into a little swing trade. 'Cause, nothing goes straight down. You're not going to go straight from 65,000 straight to 10,000. There are going to be a little bounces here and there. I mean, even on FTT token, we saw FTT token, get a little bounce. So, nothing typically goes straight down. So I will be looking at Bitcoin as a swing trade at some point. Again, not really as a investment to hold long term. BITI equals down 31 price target. Will Kevin O'Leary cover? Oh, this is a short Bitcoin. Yeah, I'm down. Wait, $31 price target? Is that what you're saying? Oh, you're saying you think this is going to come down to $31? I don't know. Do not know. And I also want to take a look. So next week is light in terms of the economic calendar, things like catalysts, different things to look forward to. But after that, we can look at the following week. So yeah, here's next week. Chicago Fed announces National Activity Index. Nothing on Tuesday. Durable goods offers, core capital, initial jobless claims. So Wednesday actually will be a decently important day. And then of course you have Thanksgiving, Black Friday. And then the week after, we can't see the next week? All right. That's fine. That's why Market watches us. Yeah, I don't think Kevin O'Leary has enough money to save FTX, to be honest with you. I mean, FTX at one point was valued as like a $30-40 billion at one point, FTX was valued at like a $40 billion company. Not anymore. Obviously not. All right, guys. Other big news. So I don't know if you guys have seen this on Twitter. So I like Twitter, it looks like, it appears, the way people are talking about it on Twitter, it looks like the thing is about to go under, just stop working. I haven't seen, like, you know, this week it seems like that hasn't really been the case. Like that you know, people are still tweeting, yet they're tweeting about Twitter being gone. I don't really get it. I don't really understand how that can be possible, how you're reading on Twitter about Twitter being dead, because it's not dead as of now. It's still going, but honestly, things not going well for Twitter, for Elon Musk over at Twitter, and it's weighing on Tesla shares. I think it's hard to imagine that, you know, if you're an investor in Tesla and you have Elon Musk that's spending a lot of his time over at Twitter right now, like, you want Elon Musk focused on Tesla too, and it doesn't seem like that's the case. Let's go to this article here from Benzinga. Elon Musk's successor as Tesla CEO, analyst names Apple. So I guess they're picking a successor at, I don't know. Here, let's go here real quick. Go full screen on this. FTX was buying property and employee names. What does that mean? What does that mean, MD? All right, so let's see. Tesla, let's get this Hertz ad out of the way. Tesla shares came under selling pressure Thursday. Succession plan for CEO is in the works. Tesla bulls dismissed development as good corporate governance and said the change. We've long said on this show on Benzinga Live, we think that Elon Musk is going to no longer be the CEO of Tesla at a certain point. We didn't really put a date on that. I think Spencer, when he was still here, said it would be before the end of the year, which at this point still got like a month and a half left, 6 weeks, but it's looking increasingly more likely that's a case. No, I know. I think I've seen, the rumor is that a lot of people think that with the lack of employees that have stayed at Twitter over the past, I don't know, week or a couple weeks, that they're getting down to a point where it's going to be like virtually impossible to run the website. These are what people in tech that are saying this on Twitter, not me. I'm more in the boat that I'm saying I think that's all like, you know, just fears. It's not going to happen. And honestly, now what a lot of people are talking about is that if everything is fine and Elon Musk was able to trim the workforce by that much, it could be a reckoning for Silicon Valley and other big tech companies that are like, shoot, we could operate our app and maybe not everything will run as smoothly, but our overall business will ultimately be intact if we cut 75% of the case. Yeah, I mean, I know Elon has like a wide network and a lot of help, and he's even willing to bring in Tesla engineers and employees. But good engineers and good developers are expensive and hard to come by, even in Silicon Valley. So definitely a lot of labor issues to figure out at Twitter for Elon Musk. Again, I'm not in the camp that I think Twitter's like gonna just stop working this weekend or something, like a lot of people seem to think that. I think everything will be okay. But that's what people with more tech knowledge than me are worried about and are saying. And it seems like, to me, looking at Tesla's stock price, looking at what's going on with Twitter, it seems like the market is weighing some of this Twitter stuff. Like, it doesn't seem like Tesla's trading on a vacuum. To me, it looks like the worse the Twitter situation is looking, the worse Tesla shares are going to do. Maybe it's because there's more or there's more of a risk that Elon has to sell more shares, because the worse Twitter is doing, the less likely he is to get other investors, then he'll be on the hook for the whole thing. I don't really quite know why that is, but right now, that's what I'm noticing. Even on days where tech is doing well, Tesla seems to be underperforming. So, wow, that'd be a big price. Elon himself is saying, I got longer term Fibonacci on Tesla downside target 161. Price could hit 96-ish. I want to do the math, and I want to know like how much money Elon would have at that point, because at some point with Tesla shares, if they keep depreciating, like at some point the $40 billion deal for Twitter could make up a large portion of his net worth. But he also has a lot of his net worth baked into like SpaceX and some of these other things that are private companies where the valuations aren't as clear. FTX was buying homes in Hawaii? Really? Tesla. All right, let's look at Tesla's chart. I did have, did I sell my, Or did I cover my Tesla short in my Wealthbase account? Coinbase is also getting hammered today, which I feel stupid because I feel like that was like the easiest short in the world going into the week. You have two sides here. Some people were arguing that FTX blowing up was actually bullish for Coinbase because, I mean, think about it. FTX was the second largest crypto exchange in the world, and Coinbase is the largest one in the US. So all these US customers that might have been on FTX US basically don't have to come to Coinbase, but it's an opportunity for Coinbase to grab a lot of market share. But the flip side of that is if it's bad for the industry overall, which I think it is, the FTX situation is bad for the crypto industry overall, then that's going to end up being bad for Coinbase. And Bank of America came out with a note today basically saying they're no longer long Coinbase, basically saying what I'm saying, that the industry, it's going to be more of a headwind for Coinbase, FTX going down, than any sort of a tailwind. So let's take a look at Coinbase's stock, then we'll get into Tesla. Coinbase trading down about 7%, actually coming up from its lows here a little bit. Looking at the 5-minute chart here, not anything like, oh my God, we're breaking out here, but it is off its lows slightly if you want to try to say something nice about Coinbase. But looking at the daily chart here, I mean, this thing is just ugly. It had been consolidating down here for a while, and I was actually starting to get interested in Coinbase. Here's why. Is because when we were trading down here, if you look at our price action from about May 12th to August 2nd, so these about 3 months, we'll call it. What is this stock doing? It's pretty flat, right? It's going up and down a little bit, but right where my cursor is, like this whole 3-month period here, I'll draw a line. Boom. Pretty flat. It's staying in this range. In this time, if you look at Bitcoin's chart, there were times, and Bitcoin kind of similarly, like, and here we can actually overlay, compare BTC. So there were times where Bitcoin was actually moving lower, and on days where like Bitcoin, I wish we had the daily candles here on Bitcoin so we could see it, because there were days where Bitcoin would say go down 3 or 4%, and typically on days like that you would see Coinbase's stock getting hit, but it wasn't going down. And the fact that Coinbase had been consolidating down there even when Bitcoin had continued to drop was a good sign to me. But now we're starting to move lower again, and of course, you've got fundamental catalysts here with FTX and the potential that the whole essentially crypto industry is not going to collapse overnight. But for all intents and purposes, it's not going to look the same, let's say, the Monday after Thanksgiving this year as the Monday after Thanksgiving last year. And last year, Bitcoin, we were above 60,000 at Thanksgiving time. This year, we're going to be below 20,000. And I think a lot of the talk, whereas last year, the crypto talk at Thanksgiving might have been, you know what, actually, now that I'm thinking about it, that would make a funny skit, right? 2021 Thanksgiving. Hey, son, what's this Ethereum? Can you help me buy some Ethereum? Like, I want to figure this out. Versus Thanksgiving dinner this year is going to be all about FTX and the crypto scams and all this. So, again, I'm not saying the crypto industry, broken overnight, but I think the FTX fallout will have serious impact and changes throughout the industry for years to come. And even if that results in 10% less people that would have gone on Coinbase and bought Bitcoin over the last year or 2 years, and now they're not going to because of the FTX thing, because now crypto's being put in a bad light, that's going to be terrible for Coinbase. And honestly, I don't even know if the stock trading at $45 right now is reflecting that. I'd still be short here. I would still rather be short Coinbase at $45 than long. All right, what do I need to do? I'm going to sell this. I'm going into my Wealthbase account. We're going to make some trades here. We're going to dig out of this hole. Scared money don't make money. That's the number one rule of investing. Boom. We're going to sell our BABA. We are going to sell our Meta. We're going to actually, you know what we're going to do? We're just going to liquidate the whole portfolio. Liquidate all. And we are going to go long, or actually no, we're going to go short Coinbase, sell short, boom. What should we go long? What are our top movers? We'll buy some Fortinet. Buying some Fortinet, FTNT, Fang, Diamondback Energy. Yeah, no, not that interesting. How about Ross Stores? Up 10% today. Woo! Love me a good Ross. Honestly, all these, like, we should have been buying a lot of these cheap, not cheap, I shouldn't say cheap, but a lot of the, like, value chains, right? You know, the dollar stores, the Ross Dress for Less. It's like how, Jay Rice, we were talking about this in the chat the other day. Walmart's been way outperforming Target, you know, so... What was the other one like that, where it was one company in the same industry that was just not doing the same thing as the other companies in the industry? Oh, it was O'Reilly's Auto Parts and AutoZone. Oh no. Oh no. Alright guys. I'm sorry, I'm getting chewed up on some SPY calls right now. Go to 5-minute chart. Ooh. Bad 5-minute candle here. Alright guys, my SPY calls might be dead in the water unless I'm not holding out hope. We just need a big afternoon rally. We need one of those 2020 COVID time rally. Do you guys remember, like, I feel like Friday rallies were an every week thing during the COVID markets. During, like, May 2020, every single Friday at, like, 3 p.m., the markets were just absolute rally. No one wanted to be stuck short. UNH is just an absolute freaking monster. I mean, I think it's not making new all-time highs, but I mean, it's basically at all-time highs. It's just one of those things that, like, I think your big risk with UNH is a regulatory risk. I think people are increasingly getting more and more fed up with with our insurance healthcare system, and UNH, I'm not going to say has like a monopoly on what they do, but I'm pretty sure from what I understand from a lot of people in healthcare policy, they say like UNH, United Healthcare, is one of the big problems essentially in our healthcare industry, and essentially making money off of like, I don't know. I don't really think, you know, companies like UNH as a public company, its CEO's now job is to try to return as much value to shareholders. It has to continue. It has to prove it can continue to grow. All these things. And if you're in the business of healthcare, if you're in the business of health insurance and providing healthcare, your primary goal shouldn't be increasing its revenue and today's the option expiration date. Oh, you're saying for the Friday rallies? And again, I'm not saying any of this in the sense that I think they're bad investments. It's like, to me, it's like holding like a private prison company. What's the one that Michael Burry's in? Geo. Then what's the other one? Oh wow. I mean, yeah. Look at Geo doing. What's the other one? There's Geo. Here, I can just go here. Peers. There's one other big one. It's not even on here. What I'm thinking of. CVO or something like that. No. I don't know. Someone else might have it in the chat. Apple, last 2 days are buying lots of puts out 6 to 8 months. Uh-oh. What do these people know that are buying puts? Yeah, I mean, honestly, the charts like don't look great, I don't think, in terms of a lot of the big names. Like you're still making lower highs here unless we can take out this. But I mean, the big levels to watch are going to be this 350 level on the SPY, 400 level, and then this 430 level. You basically have three levels: a level on the high side, a level to kind of a 400 level that's going to act as resistance and support if we get above it, and then of course this previous low that we set. You know, if we end up moving up toward this 430 level and take it out, that's an extremely bullish sign. If we take out this previous low of 350, Conversely, that's an extremely, extremely bearish sign. So I would just be cognizant like of those levels, kind of be watching. But right now, I mean, you can see at least in the interim, the trend has been an uptrend here on the S&P 500. And until we get like a complete rollover and start coming back down here to the 370 level, I'm still going to be interim short-term bullish on the S&P 500. Of course, as I'm talking here, we're moving lower and lower. We'll pull up this 5-minute chart. See if we take out the lows of the day. Looks like we got down to right at 394 flat. We're at about 395.50 right now. So we'll see if we get down to those lows of the day. BABA's 100s expire next Friday. You're looking at BABA $100 calls that expire next Friday. Is that what you're saying? I don't think this thing is hitting $100 next week, and you know me, I like this stock. I'm a BABA fan. I'm a BABA believer. See, people are like, oh, BABA's already gone up, and it is. I mean, you can see down here. Actually, you probably can't see because the purple is really hard to see. Here, let's fix that real quick. I don't know how. Every day I change this, and every day it comes back purple. So yeah, on the RSI, you can see we're getting kind of down here to oversold or overbought territory up near 70. But people, and I do think I said this too, and we are getting that little pullback today. But I mean, when you look at the daily chart zoomed out, like you're still all the way down here. You've got one little tiny move to the upside from like 60 to 80, but this thing is still so beaten up. It's not like, if you were... You want best way for fantasy, you have to play earnings. Look at next week's calendar. I know, and I tried to do that with NVIDIA this week and didn't really work out. Let's go back here real quick. Oh man, my portfolio not doing too hot. Not doing too hot. What do I even have right now? Oh, I'm short Coinbase. All right, I'm up $100 on the Coinbase short. I'm down on the Fortinet trade. I need like a stock that moves a lot. You know what I'm gonna buy? I'm gonna buy some Upstart. Upstart moves a lot. 20,000 shares of Upstart. And then should we buy some ETH too? Or how about some FTT token? I'll buy a couple $1,000s of FTT token. What's the worst that can happen? No, actually, yeah, sure. Why not? It's fake money. Scared money don't make money. All right, still got 35,000 trading available. All right, let's take some tickers from the chat. Jim Cruz wants to look at Melly. I don't know what that is, but we'll look at it. Jim Cruz, my guy. What's everyone doing this weekend, by the way? Any big plans? I think I'm driving back home to St. Louis. Spend some time with fam for the holiday next week. Oh, yeah. Next week, there's a strong chance we won't be doing Benzinga Live at all next week because I think I'll be home in St. Louis all week and I don't have a good place to stream from there. All right, Marco Nacho Libre Inc. First of all, what does this company do? So if you guys are new to this, I'm on Benzinga Pro right now. Benzinga Pros are like one-stop shop for all your stock trading needs. If you're a day trader or you're making trades on a daily basis, Benzinga Pro is for you. If you're just like long-term investing and you're not really like trading that much, Benzinga Pro probably not. But for news, for scanners, for charts, options alerts, all these things on Benzinga Pro, I use it literally every single day. So I'm just in the overview tab. The first thing I do if I don't know a company that well, I come here. Runs the largest e-commerce marketplace in Latin America. All right, so it's like a Latin American Amazon. Shipping solutions, a payment and finance operation, advertisements. It almost sounds like a Latin Alibaba, to be honest with you. And you guys know how much I like Alibaba. So weekly chart. Let's go to the fundies, all the fundamentals. Wow. I mean, yeah, it's still super expensive, which I guess makes sense considering the industry it's in. A lot of growth in e-commerce and a lot of growth in e-commerce in emerging markets, so Latin American. So, I mean, I don't know. Hold on. I honestly don't know. Like, I feel stupid for saying this, that I don't know too much about this company. But if you know the company and you're willing to pay for an expensive name in this environment because you think that growth is legitimate, you think that growth is there and that growth is going to continue to be there, then I'll never argue against an investment thesis like that. But what I will say is that in this market environment, when I say market environment, I'm talking about high interest rates, growth is not in favor. Names that are expensive with high valuations because there's a lot of expected growth are just not in favor right now. There's less of an incentive. There's less of an appetite to buy those names. So I would just be wary of that if you are buying it. Lunchtime, it trades like CMG, like Amazon in South America. Yeah. And again, I mean, it sounds like the industry, there's a lot of growth opportunity there. Because like I said, e-commerce, I mean, even right now, e-commerce still makes up like a fraction of the total global sales. So you'd expect e-commerce to continue to grow. And then you have the emerging market aspect too, where most of the Latin American countries are growing. Their economies are growing at a faster rate, or maybe not that they're growing at a faster rate, but there's more growth potential there in like developing countries or countries that are have more development to do than say the United States. I do think it's worth looking at investment opportunities. SPY thoughts, please. All right, I'll give you my SPY thoughts, although just know that I'm going to be a little bit biased because I am long right now, SPY. I'm getting chewed up on. Oh, my God. Golly. Holy cow. All right. I don't know. This is looking all pretty bearish. We just made new lows for the day. So, yeah. I'd say bearish until proven not. Like, at some point, we're going to get a bounce here. And when we get that bounce, maybe we end up taking out that levels that get some people more bullish. But for right now, we're bearish, and that's the trend. We are bouncing up off the lows a little bit. We dropped all the way down to pretty much 390, 330, now up to 390, 370 right now. But yeah, man, I mean, this looks bearish. Intraday bearish, long term. You can see my trend line here. I don't think that really changes with a little sell-off here. Like, the only way I would get more bearish SPY in really the interim is if we break below this 380 level, kind of where my cursor is right now. But intraday, certainly bearish. That doesn't mean I'm bearish the SPY going forward. Yeah, I'm right there with you. I'm in some, well, not zero date expiration, but some that expire next Monday, and mine are getting chewed up too, down 47% right now. So yeah, I mean, if you've still got value in there, I would set that you want to retain that value and the equity that you have in the calls right now. I would sell them because I think there's a good chance the SPY does continue to move lower today. And this isn't investment advice. This is just what I would do. And then if you want to get long again, you can maybe later in the afternoon when it looks like things are looking a little bit better. But at least right now, knock on wood, we've stopped going down. So if you've held and now they're coming back a little bit, hopefully. But yeah, things ain't looking good. Ain't looking pretty to me on the S&P 500 5-minute chart. Unrelated to stocks, but I could have swore I heard Carol Masser from Bloomberg say her name, maybe. What was she talking about? Hopefully good things. Watching Rock and Roll Hall of Fame in 1923 this weekend. What is that? Oh, man. All right. Yep, we're back down to pretty much lows of the day on SPY. Come on, SPY. Come on now. Give us a green candle here. Give us a green candle. Seekin saying, I recommend everyone study Wyckoff and Stan Weinstein swings. Yeah, that was an absolute butchering of the name, Weinstein. Seekin. People at my synagogue would not be happy with you. Oh man, I'm upset. I've had not really a bad trading day. So I had meta calls. Okay, I don't understand this, by the way. I had meta calls that expired today, and they, first of all, so there were 12 calls. I was talking about them with Steve Kalasian yesterday. The stock was trading up. So right where my cursor is right here is pre-market. The stock was trading at about 114 pre-market, and I would have been able to sell my calls for like a 300% gain right when the market opened. I don't understand how the stock went from being 114 pre-market to 111 or 112 when the market opened. So right when the market opened, my calls were actually down. But I was like, all right, well, screw it. I might as well just hold on to them now. They're not worth much anymore. And the stock came ripping back. And when it got up to here, it hit intraday highs of 114.32. I was up a pretty penny on these, and of course, I got greedy. And well, I didn't get too greedy because I was putting stop losses in. And I was raising my stop loss, so as the price of the option contracts were going higher, I was locking in more and more profits. But I could have just sold them all. Obviously, hindsight at the top would have been nice, and I would have made a lot of money. But I still don't understand how the stock went from like 114 pre-market at 9:29 in the morning, and literally at 9:30 it dropped down to 111. I was like, just my luck. I just dropped 3K to bring my average down with 115 contracts. All right, well, that's, I was saying that it looks like the SPY was going to continue to keep moving lower, but, I like it. Scared money don't make money. Do you, man? I mean, if you're willing to take on that risk, that's $3,000 that just know that if SPY goes down another, 0.5% here, that's probably down the drain. And if we do get a bounce here and you end up recouping a lot of those, losses or whatever from here, then sell some, I would say. Inverse rocking, rug pulls everywhere. Yeah, today has not been a great day in terms of giving me confidence that we're heading in the right direction as a market. It doesn't seem like to me today is giving me a lot of confidence that next week, even though it's going to be a shortened week, I don't know. I'll keep adding to bring my average down to not lose more. I know, it's just that if the SPY keeps moving lower though, and you don't get a bounce, like you could be getting chewed up. And I'm saying this as someone who's been there. I've been there and I've done it, and it doesn't work sometimes. Sometimes you just need to cut an L, take the loss on the trade, and walk away. But again, what do I know? I mean, literally, I could be talking in 20 minutes, and S&P 500 could be in the green on the day again, and I'd welcome that. I'm rooting for that. I hope that is the case. Thank you, Bill. CXW is the other name I was looking for, with Geo is the other one that I think Michael Burry's in this one too, but both private prison stocks. I was just saying, it's kind of like owning UNH to me. Like, both of them make me feel dirty. Like, I don't feel good about owning a healthcare stock. I don't feel good about not owning any healthcare stock, but a company like UNH's job is essentially to try to figure out how it can make the most money off like medical transactions. So when you're bitching about, your medical bill being like X amount of money or whatever, like the way that United Health works with insurance companies, like it's a big problem apparently. Again, I'm not in the industry, so I don't know. And it does look like, we're continuing to move lower on the SPYs. Let's go here on the 5-minute chart. Come on, SPY. Come on. We are all right. So I don't know how much like people you want to talk about RSI on different time charts. Like we can look at, but when you're looking at the RSI down here on the 5-minute chart, it is getting to oversold territory. So I guess if you're looking for something nice to say about SPY, you can say that it's starting to get oversold. So maybe we can look for a little bit of a bounce. But again, the fact that we're making new intraday lows, bearish to me. I'm in long SPY right now, so I'm getting chewed up on this right now. So I don't know. I'm right there with you. Whoever was asking in the chat about that. Well, if recession is going to be here next year, short list will be a long one. Well, here's the thing: is that I think like even if we do get more of a recession next year than we have now, I think a lot of it's like priced into the stocks, and that's what we talk about with stocks being kind of 6 months ahead of a lot of what you see in the economy, like from a fundamental standpoint. That if it does look increasingly like a recession next year, say next April, May, we're talking about 2 quarters in 2023 of negative GDP. That's when I'll be buying a lot of stocks. That's when I'll be buying a lot because the market's usually 6 months ahead or so. So if that is the case, I do think we'll move lower than we are now, 100%. But that I think at least a lot of that move would have already been priced in at that point. RSI pretty much useless thing is ridiculous. Yeah, I actually kind of tend to agree. I think a lot of different indicators can be. People take from them what they will. Obviously, it's not like the RSI is some magical thing, and every time it hits 20, you can just buy, and every time it hits 70, you can just sell and make a bunch of money. But I do think, some people like to use it to give you some sort of an idea of just how the momentum's going in the stock. Is it going up or down? But I don't know. I don't think it's necessarily useless. I don't think it's also, again, like the buy all end up, your one true thing to get you to buy stocks should be the RSI. I'm not saying that. There are lots that are not near 2020 lows. Yeah, I think there are a lot of stocks that aren't near 2020 lows. There are a lot now that are getting lower than 2022 lows, right? You look at an ARKK, right? We go out to a zoom out on the daily chart here. Here's the COVID low. Here's where we're at now. So you take a company like ARK, all right, you're back to the COVID lows, much different than a company like Chevron. Here's the COVID lows in Chevron, $52. You're at $181 right now. But I think that's a good sign for the economy. The fact that an energy company like Chevron's doing so well still up here, it might be setting up for a short at some point. I don't know. But it is also telling me just that the economy's been pretty strong, that demand for oil, seriously, man, I see things that trade above 80 and continue to rally. What? And I think that's, I almost think that's expected, right? That, things get overbought, right? Like take Ethereum or ARK, for example. Go back to ARK. Like you're not gonna tell me that ARK wasn't extended up here. Before COVID hit, ARK was trading at $60. A couple months later, next thing you know, it's $100. Of course it's overextended there. Of course it's probably overbought up there. But it continued to run, and that's kind of the nature, is that things that are overbought, people get excited about them. Ethereum, look at Ethereum. Ethereum was up 10% every single day for months and months and months. And then they continue to run. I think the point of the RSI showing you that it's overbought is just that the expectation is, okay, eventually you're going to expect some sort of a sell-off, which you end up getting. And it's not like, okay, the RSI hits 80, so boom, today it's going to sell off. But, okay, the RSI hits 80, okay, it's getting overbought. Okay, there's going to be a sell-off that comes, that's going to come. And especially the more extreme the RSI is, I'd say the more likely you are to see that sort of sell-off. And again, I'm saying this as someone who's not a huge RSI. I'm just trying to explain why I think some people do like to look at it, like to use it. All right, so SPY did come back a little bit. 393.90 right now. I want to see us get back green in the day first, before I start getting real excited about any prospects, any chances of really having a good afternoon rally. But it is good to see a little comeback. Maybe whoever that was that dumped another 3K into their SPY calls might want to take some profits there on those a little bit, just to cover make sure you're walking away with something. But all right, guys, I see my man Eric hanging out backstage. So without further ado, let's go ahead and get to our first guest of the day. We're gonna go ahead and give Eric our very special, very own Benzinga Zinger Nation welcome, and see what Eric's been watching today. E-Man, Eric, how's it going?
What's up, brother? So I'm looking at SPY open interest for options expiring today, just dovetailing off of what you were just talking about.
Yeah.
And there are 1.6 million open contracts on the call side and 3.5 million contracts on the put side. So there's a lot of downward pressure here, especially going into expiration. It's not a huge expiration just because this isn't like a huge month, but it is a monthly expiration. So I just bring that up because you guys were talking about, the relative strength of the product, but just based on the depth of options content out there right now, we're looking like we got some overhead there.
Yeah, and so would you mind like breaking that down a little bit? Why that kind of matters? Like why the price of SPY could be impacted by how many put contracts are out there, by the fact that there are more open put contracts versus call contracts?
Yeah, there's a lot of different ways you can look at it. The very first one in the simplest form is called a put-call ratio, and this just brings up a general hypothesis on where the market thinks things are going, because a lot of people trade equities, but a lot of smart money trades derivatives, and it's because of leverage. It's just way more efficient for a lot of them. So in this instance, when we see like really big disparities between the number of calls and puts, we normally expect to see more puts than calls. That's normal. We call that contango, and it's or put skew. And the reason why it exists is because people want insurance. They are willing to pay for the insurance. That's why we expect to see puts up. However, when it's like 2 times the size, that's a lot. And as you observe the relationships over time, you can tell what normal put skew is and what slightly higher put skew looks like. So in this case, we have a pretty high put skew. And then the other thing that drives the market force, particularly on days like today, expiration on a monthly expiration where there's more open interest in general, is all of the market makers are hedged right now. So the people that are out there facilitating all of these transactions, whenever they are facilitating the movement of an options contract, they have to hedge off the risk because they're not trying to expose themselves to the risk. They just want to capture the bid-ask spread, make their money, and move on with their day. So in this case, and this is why we see markets trend very regularly on expirations, because as all of these options fall off, all of the market makers need to flatten before the day's over, because what's going to happen is tomorrow, all of the option contracts are gone. So if the market makers are still holding all of their hedges, there's nothing they're hedging against. They're now just holding risk, and they don't want that. So they have to trade the underlying to unwind their hedges as we come into expiration, which moves price.
Got it, and that makes sense. I think, and is it kind of just like in general the idea that, okay, like you mentioned the derivatives markets, like these traders, like the big hedge funds and stuff, they're doing it because you get leverage, it's more efficient, and like it's safe to assume that when you see a huge skew like that, like double the amount of puts, like these guys know what they're doing, right? Like it's not like they're going out here just like YOLO betting.
Yeah, I mean, it's definitely a different methodology than what a lot of retail traders use. But the skew right now, I wouldn't even call it like super extreme. It's extreme, but it's not like that crazy. Like 2 times puts to calls is not like outside the norm. But the main thing is there is, like you said, a typical reason for it when we start to see the put side skewing beyond whatever the normal relationship is. So I think you're spot on there. And you can always figure out, right, like where the big people are, because there's some centralized positions in the puts. Like, so like right now, they're expiring today. There's 134,000 open contracts of the 345 puts. So obviously those are super far away. That doesn't look like it's going to happen. But you can look to see where a lot of this critical mass is. And if there is critical mass close to spot price, that's when we start to see things like pin risk, where we might see market makers trying to bid things up just a little bit to start unwinding their positions against a bunch of stops. Like, that's super normal. So I know it's a little bit of a, I don't know, multifaceted conversation. The way that I would summarize it as, there's a lot of money out there that's going to move on monthly expirations, essentially.
Yeah, and I would be curious too. I mean, because I know there are so richer and wiser monthly. When people say monthly expirations, it's the third Friday in every month. Correct, Eric?
Bingo, exactly. So with a lot of really high volume products that have a lot of liquidity, we've slowly added a bunch of expirations. So now we have Mondays, Wednesdays. We just added Tuesdays and Thursdays for things like SPY, IWM, QQQ. So a lot of the indices, index ETFs, they will have those additional expirations, but nonetheless, most of the volume is still going to be wrapped up in the monthly expirations. And it's because we're looking for liquidity. If I can find a smaller bid-ask spread that generally fits with my trade hypothesis and duration, I'm going to go to that one. So almost always you're going to see a higher concentration of open interest within the monthly expirations, the standard expirations, as we would refer to them as.
Got it. And yeah, I mean, I assume though there are still days where like the big derivatives traders, the big options traders, like get it wrong and they get chewed up, right? Like I remember I've seen days like that where like, oh my God, there were so many puts today and the market went up, like that, you know, hedge funds had to have gotten like chewed up today, you know, and it's probably not the norm, but it is interesting when that happens.
Yeah, for sure. And the thing to remember is that there's two different forces here. The open interest, obviously, as you're highlighting, is going to be brought by the counterparty. But on expiration day, that's when the market makers get involved. So even though the puts or the calls might be quote unquote right or wrong as they assimilate to zero, right? Coming to expiration is delta 1 or delta 0, if they're in the money or out of the money. When market makers, no matter what, they have to manage their positions. So that's when we can start to see some interesting market movement, regardless of what's in the money, what's out of the money. The fact of the matter is there's a lot of open interest out there, specifically on the put side today. There's going to be 3.5 million less contracts come tomorrow when everything's settled. All of those hedges have to be unwound today. Otherwise, again, like I was saying, it's just risk that's held. So there's really two interesting ways to look at this stuff. We have one, which is the overall size and amount of open interest. I track put call ratios pretty carefully. But then on expiration days, we have this added function where the middleman, the market makers, they need to unwind. So we get that added kick in. That's why we have things like triple witching, when we have multiple styles of derivatives all expiring on the same day. That's why volume on those days goes through the roof, because we need to unwind hedges for futures. We need to unwind hedges for the ETFs, the indices. All of those products can align on the same days, which become very busy trading days.
Got it. So Eric, what have you been watching this week in terms of like trades? And I know you're usually trading you know, either long or short volatility. What's been you know, the things you've been watching?
Yeah, so this week I've actually been trading. I've moved from SPX. I was trading that more recently for exactly what you were just highlighting, just kind of the shorter term duration volatility plays. And I'm noticing that the variance risk premium is essentially inverted slightly. It's starting to come back to norm, but it's still slightly inverted. So I moved over to IWM, which gave me slightly better variance exposure. And I've been managing some short-term positions in that, but I'm getting way more directional. So when I see things like the variance risk premium, if it's nice and wide, it gives me a big berth. I can trade just volatility outright. I can find enough edge there that it makes sense, and it's all good. When it starts to contract and there's not as big of a variance, that's when I start trading things like individual products and things like that, or I will trade the indices, but more directional. So I have been trading a ton of individual products I normally try to share as much as I possibly can about everything I do. With that, I can't go into like super specifics because some of those products are very small and they can be priced out very quickly. So I talk about the indices because everybody and their brother knows about the indices. There's nothing to get outpriced there. It's already there. So yeah, that's mostly been it. And then earnings. There was some really good earnings this cycle. So Home Depot, when they reported, I was very, very surprised to see the overall movement we got out of them post-release, but they had a really nice contraction in implied volatility.
Who is this?
Home Depot. They beat slightly. Yeah, so they came in pretty good. And another couple ones that I was looking at earlier this week, Walmart and Target and Nvidia. So I traded earnings in those three as well. Target was an easy short, so I came into that one with short calls. Nvidia was a short straddle that luckily worked out. Nvidia was kind of boring, to be honest.
Yeah, that didn't move much after its earnings. Like it typically does.
And honestly, the implied volatility contraction wasn't anything to write home about either. It hardly moved. It was actually pretty frustrating for me because it looked like it was going to be like right on the button, exactly what I wanted. They reported after the market on the 16th. So then on the 17th, when it opened up, implied volatility contracted down to like 58%, and historic at that point was like 68%. So it was like 10 points, which is good. But for earnings, I would expect ideally a little bit more than that. So I was very neutral in Nvidia. That worked out. In Home Depot, I got to fight for my life. I had short calls in Home Depot, but they were far enough out that I essentially just had to wait until the end of the day to be able to take them down as a profit. But when Home Depot first opened after the report, that was not my favorite opening. But yeah, overall earnings has been on the table pretty good. Slowing down though after this week, we're really scraping the bottom of the barrel. I also thought the earnings release, I wanted to ask your opinion on the earnings releases that we got. I listened to Walmart and Target, and I thought they were very interesting what they were talking about. Did you catch either of those?
No, not this time around. I know Target's earnings call a couple quarters ago was a big deal when it was talking about its inventory, and that was kind of like a big warning. That was the here, I'll pull up Target's chart, and that was the one I'm talking about is like the big. It dropped off like 20. I think this one right here back in May dropped off like 20% and 25% in a day for Target, which was crazy to see. I never thought I'd see Target move like that in a day.
I love to see it. I hate Target with their stupid plastic carts and I don't know, the red pylons outside the front, little balls. I'm a Walmart kind of guy. Like I want to go in to be able to buy like some ground beef, shotgun shells, and some sandals if I need to, and you just can't pull that off at a Target.
Yeah, Walmart's great for anything. Like you said, you can buy no matter what you need. You can buy stuff to fix your car and then fix dinner in the same trip, and
exactly.
you can't do that at basically anywhere else.
But yeah, the earnings releases were very interesting to listen to because just as you were talking about the last one where they dropped like a rock, it was not as bad, but it was still very similar where they were very, very conservative in their forward guidance. Nobody is comfortable, especially in retail right now, as they're looking out over, several months into the next quarter. They're all guiding so softly, which I thought was interesting because we just got decent economic data that showed, that inflation wasn't necessarily marching through the roof still hovering pretty high, but starting to move in the right direction. But retail obviously is seeing a slightly different side of that right now, but there's always going to be lag between the two.
Right. Someone in the chat was talking about Ross stores, which is interesting because it's kind of like the same dynamic where I think over the past year or so where people have been more worried about inflation, been more worried about different things, like more of these value brands have benefited from it, Ross, Walmart, whereas the more quote unquote I'm not going to call Target luxury, but the more expensive brands haven't been doing well. But Ross is seen as kind of that value brand. You want to go to a Ross if you're trying to save some money. And by the way, Ross stores are like a TJ Maxx. Basically, any of these stores, what they do is they'll just buy stuff from like Macy's, the big department stores that don't sell. If you need a place to go buy like socks, underwear, t-shirts, best place to go in the world, because like who cares if I buy last year's Hanes underwear? Like it's still good Hanes underwear, but it's going to be $8 for a pack of 10 instead of 30. It's amazing. I love those stores.
I'm just saying, I expect you to be in the latest and greatest underwear, because
maybe if you get me some good options trades, Eric, then this year that'll be my Christmas present to myself. I'll get myself the 2022, the hottest underwear out there.
Now we're talking. That's right. Now, just as I was actually kind of talking some crap about Target, I actually really like, they have this brand called Pair of Thieves, and I really like those underwear. So Target got that right. I'll give credit where credit's due. I
have seen those before. Maybe I'll have to check some of those out.
I'm looking at Ross now, man, and I am blown away by this move, but I'm actually looking at fading it, like as we're talking, because I don't think it's staying there.
Yeah, I mean, I don't know either. I don't know. I mean, Macy's had a big move yesterday as well. A lot of these department store names aren't doing too shabby. I think, for all the fear of recessions and stuff, I think consumer demand has actually, not been amazing, but held up, I think, better than a lot of people have expected.
Yeah, man, this is interesting. So the at the money put call ratio in Ross stores right now is 0.17, which again, normally I would expect to see more puts than calls, especially with something that's trading quite this high. Implied volatility is pretty low, but I'm still gonna fade it probably right now because very high.
Yeah. All right, Eric, well, let's see if we've got any other tickers flying in the chat or anything else that you've been watching, anything top of your mind. We've only got about 10 minutes left of the show.
Yeah, dude. So one of them that I think, well, in the meantime, happy to pivot, just filling the space, but happy to pivot whatever's in the chat. But one of the things that I've been following pretty carefully is just the general market breadth. So I use things like new highs and lows, the summation index, advanced decline cumulative average, like things like that. And that's been fascinating because like we're starting to see the smallest semblance of daylight than we have in a long time. We've been really, really struggling to see broad market breadth indicators like that turning positive. But we are slowly starting to see some bottoming patterns here and things showing relative strength compared to where it's been the last year. So that has been really interesting to me, specifically as it comes to looking at where are we bottoming, because there's a lot of conversation about that right now, in my opinion. I'm curious what your take is on that. But to me, I'm still seeing a general, just pretty aggressive stage 4 decline. Like I think we're coming down pretty heavy, but we are starting to see some basing. We are starting to see some higher lows. So it's always interesting, to try to figure out when roughly we're starting to bottom out. But have you taken a look at any of that stuff?
No, not particularly market breadth. I think I've been kind of just watching like the bigger names that kind of drive the S&P 500, your Apples, your Microsofts, and seeing how those have been kind of performing. And it's kind of the opposite of market breadth, right? Seeing how like the big names are performing to see. So I should be looking more at that, Eric, because I think, if what you're saying is that you feel like more bullish, the higher the market breadth is, the more the overall market strength is, as opposed to just a few names. I'm in complete agreement with that, right? Like I think like looking at something like the IWM, even like seeing when that gets really bullish is when that's like a sign to me, like, okay, people are willing to go risk off here and really like take some risk on.
Well, you touched my heart there, because IWM is probably one of my most, if not the most traded product for me. I trade IWM literally a ton. And I have some positions on it right now, actually. But I feel like there's no debate about it. And I think it's so important to like reiterate, like we are still very much in a stage 4 decline. There's no ifs, ands, or buts about it. Like any objective metric shows that. But I do think that we are starting to see some semblance of strength materializing, again, just via the fact that we're not continuing to fall through the floor. But I would still, again, I'm very cautious with how much risk I'm offering the market here, because it's been so emotional. Like, I've been very carefully tracking the amount of implied volatility we have out there, and things have been moving literally all over the freaking place, which has been fascinating. I was actually having a conversation with somebody about trading options earlier this week, because they were of the opinion that options make more money in down markets than trading like equities outright. And we went into this entire discussion about how options fit into the broader markets, because a lot of people, I think, get very misled by that, where they think that options provide some sort of inherent edge trading an option versus an equity, and it's just not true. But
yeah, go ahead.
I was going to ask you, as you're kind of looking at the market going forward, one of the things that I like to do, especially observing market bottoms, is to try to, not necessarily that I'm going to start loading up on them, but to try to find what I think might be the next series of market leaders, like the industries, the sectors that might start pulling the market up and out. Is there anything like that you've done, or anything that you've looked at there?
No, I do think, I think that when we do get kind of a more broad market turnaround, at least one that is going to be sustained, especially if it's accompanied with a Fed pivot, I think a lot of the kind of B2B SaaS names, really these ones that have just gotten absolutely freaking clobbered, whether you're looking at an Asana, down from $150 to $18, or you're looking at a Shopify. I actually almost like the reverse of the question. I think some of those might be the last ones to really like come around, but I think when they do come around, will outperform, your big tech names like your Apples, and just any of these names that are like somewhat legitimate companies. Like Shopify is a legitimate company that's been drawn down like 80%. Because if you go back, Eric, to the .com bubble, and you look at like what did the legitimate companies do, the Amazons, the Apples, that like they drew down 80%. They survived, but they drew down that much. And that's kind of where I see Shopify right now, is like, all right, like you drew down 80%, but if you're a real company, you're going to be around for a couple more years when growth comes back into favor. So a lot of those I'm interested in. I don't really want to like say ARC names, because there are a lot of ARC names that I don't like. I really don't like Roku. But I do like an Asana, a Shopify, a Upstart. Some of those, I think, and again, especially with a Fed pivot, I think you're going to see a little bit better returns than the bigger tech companies.
I love that. So kind of more of a tech growth style hypothesis, it seems. One of the funny things I just saw as you flip through those, though, literally each of them looks like the same damn chart. Like, no,
I know they're all ARC name. Like whether you're looking at ARC, Asana, they all growth. And I don't necessarily think, like, I think if you just think in terms of the last, let's just say from the 08 financial crisis to COVID, like the clear market leader was tech and growth, and Apple, whether you're talking big tech or whether you're talking growthy tech. And I don't know if I really expect that to continue as a macro trend, say for the next like decade, that the best market performers are just going to go straight back to these tech names. But I'm just saying, as more of like a kind of like I could see a 6-month period where Upstart, Asana, and these other growthy tech names that have been beaten down 80% actually outperform on the upside Apples, Amazons, Microsofts, and then maybe after that, maybe not, maybe they don't outperform them, but I think there will be a period of time where they are outperforming them, and I'm gearing up, I'm getting ready to trade those on that swing trade.
I love that, because a lot of people, I go back and forth too on like that same hypothesis. I have a hard time. Part of me wants to think that tech won't necessarily be the next secular bull market leader, but then part of me also says, well, what else is it going to be that has a better value proposition and can move the same way that tech still can? And I love that you're using, like historic market timeframes to create this assumption, because I think that's something a lot of traders miss out on, is they forget to look back at what's happened. Most of what we've seen, sure, there's always these, interesting offshoots that makes it unique, but they're generally the same scenarios. So I really like that play. And I think one of the things that you mentioned there, especially in like the tech growth, is I've been watching very carefully their earnings. And I don't know if you do, but one of my favorite things to do and stuff like that is to watch their earnings. I want to see their sales either flatten out, and then I want to see at least a few quarters where sales growth is expanding rapidly. And for me, that's typically like a generally decent time for like a swing trade, a longer term holding, either via options or the equity outright. But I like that hypothesis a lot.
Yeah, no, I appreciate it. And yeah, I think like I don't know why more people don't do like you said, like use the historic, like look back at what the growth companies did during 2000, and like, are the growth companies today going to be the exact same? No, but is it still the stock market? Do they still trade, is there still similarities you can pull from it? Probably.
Exactly.
But I see someone else in the chat was saying green energy and chip stuff. Definitely a lot of people looking at green energy, and if we get more money flow. Go ahead.
Just an interesting point on that is there's been a lot of, debate in the energy space. It's almost like, when people talk about politics, how they all get their pitchforks to stab one another. It's like the same thing within energy. I'm seeing like the green energy people wanting to fight the oil people. And I've been seeing a ton of really interesting dialogue around, like Warren Buffett's purchase of Occidental and things like that, because people are thinking, that oil is essentially going to die off in 5 years. I personally don't believe that hypothesis, but I can understand it. And I think green energy still has a huge use case here, obviously. I think the main fight green energy still has in front of it is scalability. There is no replacing, fossil fuels as we have it right now, or nuclear fuels as we have it now, until we can scale more aggressively, which if green energy does crack that nut effectively, I just like that person was chatting in, I really think it has the potential to go wild.
Yeah, I mean, certainly, the energy trade, there's always going to be an energy trade to be had, right? We're always going to need energy, whether it's oil, whether it's gas, whether it's clean energy, whether it's hydrogen, whether it's nuclear. Like, we're always going to need energy. There's always going to be an energy trade to be had. Let's see. All right, well, Eric, it's about 12:57 right now, so let's curb the conversation. Let's leave it there for today. And then next week, next week, no good, because that's going to be Black Friday or day after Thanksgiving. I don't think I'm not saying I'm going to be out at the malls shopping. Maybe I will be, but I don't think we're going to be doing Benzinga TV next Friday. I don't know. We'll see. But either way, we'll get the real course started soon, which was actually, this is good. So that way we didn't start the course or the content we were going to do today and then have to stop next week. So all worked out well. But Eric, thanks again, as always, for hopping on the show today.
I had a quick question for you.
Of course.
What is your weight set to?
Oh, on one of these grip trainer? I don't know if this one has we just have like
yours is just the full bar? You don't have the individual fingers?
No, we got individual fingers. Wait, here, I'll give you a zoom in.
Oh, there we go. Okay,
but there's you can't
adjust it.
I don't think so. Not that I can tell.
Damn.
It says it's a grip master. Oh, it says medium tension. So I'm medium right now.
We gotta hook you up with one. This has like these little screw things that I can make it tighter.
Well, we have multiple. There are other grip trainers. So what do? You just use it as like a fidget tool, or are you actually like strengthening your wrists for jujitsu?
I have really subpar grip in my opinion. So it's something that I've been like laser focused on. Because like when I'm deadlifting or something, I hate that my grip gives out. So I literally have like a whole little thing here that I do throughout the day.
Yeah, so we have one of that red one you picked up. We have one of those too, and that one you can twist a knob on.
Yeah, but this one only goes up to like 60 kilograms, so you can get something out of it. But I don't know, it's not as effective. It's always funny to see how awful my pinky is, which is why I like this one, because the pinky is just so weak, dude.
Yeah, no, I mean, crazy. They are fun to mess around with, though. Little grip trainers for anyone that doesn't know what we're talking about. But Eric, I'm going to drop your Twitter in the chat at ESInvest for folks that want to go give you a follow. Enjoy your weekend, man. Enjoy your holiday next week. Hopefully, I don't know what your plans are. Hopefully, you'll get to see some family. Are you traveling or staying out in California?
It'll be a mix of both. I actually think the wife and I, we might be going over to Ireland for like a week and a half, and then we'll come back and see family. We'll either see them on the way out or on the way back. So my family's on the East Coast, so we'll fly from California, East Coast, see people, then go.
Wow, Ireland. That'll be fun. All right, man. Well, enjoy your weekend. Again, at ES Invests on Twitter. Eric, thanks for hopping on the show. We'll chat soon.
See you, bro.
All right, guys. Fun Friday show, 1 p.m. Eastern. You know what that means. That means it is time for me to hand it over to my man, Money Mitch. Money Mitch will take good care of you stock market movers starting up. But before we get there, I do want to tell y'all a little bit about our event coming up in New York City, the FinTech Awards, as well as the Future of Crypto event. I'm going to be there. Mitch is going to be there. We're going to be there in Times Square having a good time doing man on the street. If you want to come, you got to come to New York City. You got to get on the New York man on the street interviews with us. You got to learn more about crypto. Benzinga.com/events-crypto. Use the code AB20. Without further ado, let's go ahead and get that promo popped up on the stream. When we come back, Money Mitch has got you in good hands.
All right, team, let's get right to it. And yes, that QR code in the top corner, that can also get you over to the crypto. So if you guys want to just read that crypto, just go ahead and get that QR scanner on there and get to the future of crypto. And if you want to use Money Mitch 20 instead of AB 20, you know, I won't be mad at you. But either way, you'll get your discount. That's what matters. Let's get right to it. This is, of course, Stock Market Movers, where we get to the headlines and, of course, expert opinions to try to keep you in the informational edge. Now, I will let you know today, team, looks like we had a cancellation for our guest, but don't worry. I got a special segment today. We're going to talk about the story of potential disaster stocks. So we'll talk a little bit about some stocks coming up. I'm not going to give you the 3 stocks that I'm going to talk about because you got to wait till we get towards that segment. That's going to be towards the end of the show. I'm saving about 20 minutes for that. We'll probably do that around 1:40. So stick around. We got a lot to talk about right here, of course, on Stock Market Movers. A lot of headlines out there. Of course, Fed's talking out there, and it looks like the market is still dragging right now. We're going to see if we find a bounce here towards the close because it's been an ugly day. Even though we came up in the after hours, can someone tell this volatility to just take a pause? We'll also get into some earning stocks and cover everything out on the market today. Let's get right to it. Stock Market Movers. I'm your host, Money Mitch. Let's see what we got in today. There are 3 ways to make a living in this business. Be first, be smarter, or cheat. I can't help you cheat, but I can give you the informational edge to help you succeed in the markets. Welcome to Stock Market Movers. All the market moving headlines and expert opinions every day. They say money is the oxygen of capitalism, and I want to breathe more than any man alive. How we doing out there, team? It's good to see you guys in the chat, and say hello if for any reason you're new to the show and you're just tuning in. This is Stock Market Movers. We get into the headlines, so let's take a look first into the market. Then we'll take a look at what was being talked about yesterday. As you guys can see, the SPY coming down today, and I even got caught in a SPY trade. I tried to take a little SPY trade here off of this. Looking for the break above the 396. We went to 395.99. Can you believe it, team? Right off of a penny there, going for that 396. And then from there, downturn there. So it's been a tough day for sure in the overall market. We'll see if we can find a bounce, and definitely we'll take a look at what was hot and what was not today. But if you think about it in the daily chart, look how this has been kind of really just stuck in the middle. I'm starting to think, which way are we going to head, right? I'm not trying to use this as a trade indicator, but more of a confirmation. Will we head towards the overbought, or will we head towards the oversold on the downside? Looks like we truly bounced there after, of course, this kind of bottoming event there on the 358s. We've been going up ever since. And so I'm going to be keeping an eye out to see what happens. But definitely on the daily, not looking good. Thought we would get closer towards the 400 today. We can't even get past the 398, coming right back down. We'll see if the 9 EMA holds as support. 391 yesterday held 390s. So we'll just have to wait and see. Getting out of the overall market, let's go ahead and talk about what was said yesterday. Of course, Bullard, I think comments were probably the most important ones to catch. And yesterday, he clearly stated that he's looking at potentially the interest rates and Fed fund rate going to 5 to 7%. Well, why is he mentioning these numbers? Well, of course, a lot of it has been the talk that we've been talking about with analysts, that if we're really going to get inflation down, we probably are going to need to get inflation higher, or the fund rate higher than, of course, the core PCE, or maybe you're looking at core CPI. So that's really getting up there towards that 5% range. Of course, once you get it above that, you're going to be able to really truly be in a restrictive interest rate. And clearly, what was said yesterday by Bullard, that the policy rate is not yet in the zone that may be considered sufficiently restrictive. This is where I think that we need to kind of focus where we're going, right? Is it a 3? Is it a 3.5? Is it a 4%? Is it a 5, 6, 7% interest rate? That's going to make a big difference on when the market's truly going to reverse and continue the new bull market. I do think that we're going to get one. But of course, how long will that take? And how long will it be that their interest rates are hiking? Is it till March? We talked about this yesterday. We talked about this also with Sam Saval. He saw it going into March. Some people see it going all the way into kind of the summertime. We're just going to have to wait and see how those hike rates come in and where is the peak truly of the Fed funds. And of course, what's going to help this is also if inflation truly keeps coming down. This is what we need to keep watch to see what happens there. But it's been a good day so far. And I think one of the things that we need to kind of see is the Feds are kind of battling each other in the headlines right now. If you see, some of them are stating that we are in a sufficient rate. Some people think that we can still get a soft landing. It seems like they're conflicting right now. They're not even on the same page. And that's what we need to kind of focus on. If they're not on the same page, then maybe they're starting to get to the point where it's no longer just a hawkish approach. There are some that are starting to get more leaning towards the neutral or the dovish side. So we need to keep watch to see what happens with the Fed. Let's get out of the Fed. We can talk about some stocks that are making some moves on the day. Let's get towards the stocks that had some earnings today, and we can get into some other outlook here. All right, let's go towards the SPY here, and now we'll go towards Applied Materials. That's what I want to take a look at on the 15-minute. You guys can see here, we came right back down, even though we popped off of this earnings, pulling on back here right until the close of yesterday. And so I would look for this to kind of recover from here, but doesn't look too bad there. Applied Materials, let's get the numbers here. Q4 EPS at $2.03, beat the $1.74 estimate. Sales at $6.75 billion, beat the $6.45 billion estimate. Applied Materials did see Q1 adjusted EPS up there towards $1.75 on the low end, $2.11 on the high end versus the $1.83 estimate. They did also raise their net sales, so not a bad outlook there in Applied Materials. Did come down towards the open. We'll see if the market can catch the bounce and also AMAT catch the bounce and start making its way back towards 107 towards the close. Let's keep on going here. There's a lot more to talk about. Applied Materials just goes to show us that maybe not all the imports and the licensing controls that are coming in to the CHIPS Act is truly affecting like Applied Materials here. It looks like it's affecting other companies more, but definitely going to keep watch to see what happens here with the licensing concerns and, of course, expert curves that we need to keep watch. Let's go to Pan W as Palo Alto also reported earnings And let's get into their numbers. You can see they continued at least going higher and kind of going sideways here, pulling back towards the support. So we'll see if it eventually can make that next move up. But Palo Alto here, let's give the numbers. Q1 EPS came in at 83 cents, beating the 69-cent estimate. And sales at 1.56 billion, beating the 1.55 billion estimate. Palo Alto sees full year 23 adjusted EPS at $3.37 on the low end to $3.44 on the high end versus, of course, a $3.17 estimate. They also raised their total revenue. And I think this is one of the stocks that gives me the idea that, hey, there are some stocks that have been okay in this environment. Take a look at the monthly chart on PanW, and you're going to see how it's been holding around the 165 and 155 pullbacks. We'll see for that to kind of lead the way and maybe catch some other kind of security plays, of course, cybersecurity plays on the move up. You can see CrowdStrike's been coming down lately on the monthly, but if we go towards the daily, we want to see when CrowdStrike actually starts making its way back. This has been really beaten down. When will we be able to pick it up? One of the areas I think that will give us the lead is when PanW tries to go for that 190 breakout. We'll see what happens in that company. It looks like it's been kind of building up here around the 155, 160s. Let's see if it makes a run for the 180s and the 190s, and then we can look for kind of that leader lagger style play there in Palo Alto. Catching up with the chat. What's going on, Easy? How we doing out there, Seek? Zoltan, what's up, man? How we doing? We got Romar here joining us on the Twitch app. Since you mentioned CPE and CPI, well, PCE and CPI, I'd love to see Benzinga do a talking heads discussion of strengths and weaknesses of the two index and which is a better measure of economic health. All right, I can do that. I got no problem with that. I'll definitely can bring on a guest and try to talk about those two, what is truly different between those kind of reports. And the reports, they wouldn't be really indexes, but of course you can index them, right? But definitely, I got you. I can definitely bring on an analyst to answer that question. Let's keep going. Kenneth, what's going on out there? And can you change your lights to yellow or any other colors besides green, blue, black, purple? Because I think it's time for a change again. I got you. Oh, for Monday? Oh, we can do it right now. We can go yellow light. We can do all kinds of lights here, man. We can go green. We can go light blue. We can go orange. You can do a little orange action. There's nothing wrong with it. But I like the blue too. Let's keep it like that. All right, let's go towards some different. Oh, you want the Christmas colors too? Don't worry, Christmas is coming soon. We got to get a Christmas tree here. What do you guys think? Christmas tree? I think Christmas tree. All right, let's keep going. We'll go to the next stock here as we continue going into some stock action. Let's go towards the next one here. Let's take a look at Ross Stores as this one reported and got the nice spike. We were looking at this one to get a nice little lift. TJX had a good report, and so we were looking at this one as a potential good retail stock, especially discounted store, right? EPS coming in at $1, beating the 81-cent estimate. Sales at 4.57 billion, beat the 4.37 billion estimate. They did kind of raise their Q4 EPS and their full year 22 EPS, so not a bad outlook there. And getting the push in the pre-market, but as it opened, it pulled back, and we got to be careful with stocks like this. It seems like even the stocks that get a nice little push off their earnings are pulling back significantly and then catching the bounce. So don't be chasing too much, because that's an easy lesson here that I could see in Ross. All right, catching up with the chat. What's going on out there? Austin, when are you starting the book club? Soon, my friend, soon. The idea is to really build up I'm going to build up the club. I'm going to build up the members, everybody. And the idea for me really is starting this in January. Reason why, Austin, is not because I don't want to read right now, but I do have my CMT exam that's coming up. And you guys know I've been reading a big old book already. So let me get through this one, and then we'll start doing some book club, some nice financial club for you guys to join in and definitely appreciate you bringing it back up, Austin. We're definitely going to have fun with the Financial Book Club. Probably call it the Money Mitch Club, and then we'll definitely get books in there. What we'll do is we'll be going through chapters and going through all the lessons that we can learn from different books. I got a huge list already going for us. All right, let's keep going. We're going to take a look at some other stocks. It's good to see you guys in the chat conversing with me today. Definitely go ahead and talk it up. We'll definitely keep going on the day, and there's still a lot to talk about. I can't wait to get into a little bit later today when we talk about the story of potential disaster stocks coming up. Since when did you announce the book sale? It's not the book sale, it's a book club. But yeah, so and what is the CMT test? William Reyes is asking. So what this is really, it's the certified market technician. And so it's kind of a certification that you guys can be going for. And the big reason for me is to kind of give myself another status in the financial space. You guys know I work hard on my technicals, but I want to go ahead and get some more certifications to really kind of show that I've put in the hard work. So the CMT Association does this. It's a hard exam, but if you're kind of being into the space and you feel like you're going to be a full-time trader, these are definitely skills that I think can definitely help you. You're bringing Kramer on for the disaster stocks? Yeah, normally I just watch, Mad Money for those disaster stocks, but I hear you, Jay. Wouldn't be too bad there. All right, let's keep going. Let's go to the next stocks. We'll take a look at some of the earnings. Then we'll get into what was hot and what was not. And of course, then we'll get into those potential disaster stocks. I can't wait to hear what you guys think are those disaster stocks. And I'll leave a little room for you guys to guess them. Maybe we'll see if someone wins it and wins a prize today. All right, let's keep going. I would like to talk about some swing trading rules or ideas from time to time. Balo's talking about that. I got you. We could definitely, I've been getting more and more feedback from you guys about swing trading, and you guys want to hear a little bit more about swing trading. So I might do a swing trading only style show coming up in the next year. But like always, you guys can continue giving us feedback. One thing that we've been doing is putting out a form to get that feedback from you guys. So please, by all means, fill out the form whenever you get a chance. You don't even need to put your name. You don't need to put an email address. You can just give us the feedback of what you want to see right here on Benzinga. All right, let's keep going. Let's go to the next banner here. We're going to go to Foot Locker. Let's go to FL. How are we doing in Foot Locker? Pulling back here towards the support. Not a bad hourly pullback. These are the type of strategies that I really like. So you use like kind of the hourly lows for what I call deep time frame pullbacks. And so Foot Locker wasn't a bad report, pulling back into this support around the 34.90s. And what does this give me? It gives me an ability to risk down, maybe risk about, let's say, 40 cents here, looking for the move back up towards the 39. This is definitely a strategy that I like to take sometimes. So not a bad approach. Not telling you to take this trade, of course, on Foot Locker, but how I would like to approach this pullback. Let's talk about their numbers and what they gave today. Foot Locker came in at adjusted EPS at $1.27, beating the $1.11 estimate. Sales at $2.17 billion, beat the $2.09 billion estimate. They did raise full year EPS guidance and also raise Q4 adjusted EPS. So they're not seeing weakness, at least for right now. Raising their outlook, that's looking good there on the guidance. This doesn't look like too bad of a trade, especially on the hourly pullback. We'll see if it closes back towards the 38, going towards the 40, and then eventually I'd look for it to take out that 41.90. We'll see if it's able to pull back and make that next run. All right, and definitely see the agreements for the swing trading. When did you announce the book club? When is it supposed to happen? Said Kenneth Jones. Don't worry. I'll always let you guys know, especially right here on Stock Market Movers, what's the next move. The key for the book club is right now I'm just getting it started and just throwing out the idea. Wanted to get the feedback, and we've gotten great reception for it. So it looks like this is definitely something that we're going to do next year. But stick around, Kenneth. There's so much more to learn right here on Benzinga. Let's go towards the next stock. Let's go to JD. Actually, let's do Gap. DPS, Gap Gap had a good earnings report here. Let's talk about what they said. But on the conference call, they did give a little bit of a warning sign. We'll talk about that. Gap EPS Q3 at 71 cents. Sales at 4.04 billion, beat the 3.8 billion estimate. Gap's executives on the conference call did say, though, that we continue to rely heavily on markdowns and discounting to sell through styles this quarter and have reduced receipts in Q4. So one of the things that they're trying to let us in on is that they are still trying to get through some of the fall styling. And so they're doing some heavy markdowns to get that down. And that just shows us concerns out there for others, right? I'm sure Gap isn't the only one that has some excess inventory and is starting to do markdowns to get through the styles. So keep that in mind, and we'll have to wait and see what happens to Gap. And it looks like it pulled back, got that bounce here from the prior price action, and is now starting to get the bounce. This is not a bad level to kind of look off of. The 12.95, you see a lot of closes here where it couldn't get into the 13. Now we're using that as support. Looks like that's acting as support here. We'll look to see if it can come back up through the resistance, through the 1380s, and finally close above the 14. We'll see what happens there in Gap. All right, getting out of Gap, we're going to get into some other stocks. Of course, we'll get into what was hot and what was not, where we take a look at the intermarket analysis. This is where we look at where the rotation is going, right? This is why we keep watch here on the rotation from sector to industry, so that we can see where the money is rotating out of and where it's rotating in. Let's go towards what was hot and what was not. All right, let's go do this. I'll put the screen up here. Let's talk about utilities kind of getting a little bit of a bounce today. And how long will this last? Well, it seems like it's been holding up here. I'm going to quickly draw kind of a horizontal line here to see if we're going to be able to hold that as resistance. That is right around the 657 here. Of course, this is my sector outlook. You guys can also use different indexes or ETFs to take a look at this. Like this is utilities, but look how similar it looks to like an XLU. XLU is very similar. We'll see if that can hold the 69, right? That's where I'm looking to see if utilities come right back down. If they can get above that 69 on the XLU, well, then maybe you can start seeing some upside lift. Stocks like Duke having some lift today. NEE, NextEra Energy. We'll just see if these are able to hold. They've been pulling back. They got to bounce. Now let's see if they start turning around, as you see some of these really holding on right now. All right, let's go to healthcare. That's the next leading sector. Healthcare plans getting the bounce back today. Talked about this morning on Humana maybe getting a little bit of a bounce back. A lot of this was based off of the WBA news. As you guys can see, Walgreens Alliance did pull back here after announcing, and this was not an announcement. It was a JP Morgan upgrade from Lisa Gill. She stated that the company, and I'll go ahead and I'll throw this up here so you guys can read it at the bottom. JP Morgan analyst Lisa Gill upgraded Walgreens to overweight from neutral, stating that the company had significantly invested in transformational consumer-centric healthcare strategy, the centerpiece of which is the launch of Walgreens Healthcare, which looks to provide better experience for customers and improve outcomes and lower overall healthcare costs. That's what Gil wrote in a note. And looks like we're starting to hold that pullback. Looks like you tried to get back into that down gap and now are able to start holding it. I would draw a horizontal line there. That's the 39.40s. Needs to hold on there. If not, you could start getting into that down gap. But it looks like you just did a quite dip through that and then started coming back. So we'll see if it comes back towards the 40.10. That's the VWAP, and then starts making its way back as this has to get back all the way towards the price action, towards the 41, if it really wants to get back to the bullish tune. We'll see what happens there in Walgreens. Like I said, I was going to take a look in the healthcare plans to see how they were doing today, especially after getting that news. And it looks like some of these did well. Some of these didn't do that great, but Cigna getting a little bit of a bounce back. They had been really beaten down on that turnaround on Friday, the 11th. All right, let's keep going. Let's get out of JP Morgan and kind of the healthcare talk. Let's go towards what was not hot today. What was not hot was consumer cyclical stocks. Let's talk about those. And definitely in the chat, if you guys caught a stock that was moving up or down, let me know. Bring those pineapple shirts. That says Romar. We'll see what happens. Zunaid's not on here right now, so take it easy. We'll see whatever is going on there. Grind. Oh, I heard about grind. That was grinding and then came to a grind and halt. That's the way it is. The rate needs to state 1 bad and 5 excellent. Does not state it. FYI. Thank you, Austin. Appreciate the feedback. We did the form. Sometimes we're going to make mistakes, but appreciate it, Austin, on the feedback. I'll definitely check that out. Please check USO. William Reyes is asking. Yeah. Well, USO is, kind of weak right now. And I think that this is overall the price of oil that you're seeing it, right? Energy is slightly up on the day, and that's the kind of confusing part. But I really start to think that these oil stocks are going to start to crack. And the reason why is that oil is down below the 80 mark. So I need to take a look at WTI. Haven't taken a look at it since kind of earlier this morning, but let me go ahead and take a look. And we're at 78.82 around where I see it right now. We went to a bottom around 77. Not what you want to be seeing in crude prices. But of course, these companies are holding on. Why are they being able to hold on? Because a lot of people rotated to these names. But I feel like there's going to be a point where they're going to probably run towards those profits because it's run a pretty significant amount in the last couple of weeks. And of course, if the oil prices turn around, we could get this to drag right back down. I could see it coming back down to maybe like 108, 106, and then catching another lift. But we'll have to wait and see on ExxonMobil. USO needs to hold on to the support right here. If it breaks down here, it could be right back down towards, let's say, the 67.50s. And then from there, it could be at 66. We'll see what happens on USO. USO has definitely not been the one that has gotten the appreciation in 2002. This is why I don't like using USO, at least to trade, because it doesn't really get the appreciation. Like let's say from 2002, from where we are to now, it's only been up about 19%. Take a look at ExxonMobil since the beginning of the year. That's a 80% gain there. Take a look at Oxy since 2002. That's 150 something percent gain. Well, that's why I think it's a little bit better to maybe play those other ones. USO for me has never just done it, but hey, to each his own, right? I mean, it did make its move back up. Just didn't get as much appreciation as I thought some of the other ones would. Why not XOP? Yeah, XOP is not a bad way to take a look at it, right? I mean, you can take a look at it this way. It's not a bad one to take a look at. It's trying to make its move back up, but I don't really use the ETFs too much here for this one, but it's not a bad ETF to definitely keep on mind, right? This one looks like it's been trying to get back towards that 170. We'll see if it gets up there. If it does turn around, Chevron has been a really strong stock lately. Starting to see that one get a little bit weak there, but we'll wait and see. All right, let's go ahead. We'll take a look at some other stocks. You're looking at Tesla. I can't tell you if it's a good buy, but I will take a look at some levels for you and see if I see it in a bullish tune or not. All right, we'll take a look. Basic materials also getting into the red today, so just be careful there. There's still some that are not doing too bad. Specialty chemicals, we're just taking a look at some lithium names. They were up on the day, but now pulling back. Will these kind of get the next lift? Keep them on watch. LTHM, LAC, MP. Eventually, I think these get some nice lift here, but it's really difficult to kind of measure these out. And I would keep this, especially like the PLL on the monthly chart, to keep watch on those support to look for a nice little pushback through the 70. We'll see if we ever get it. All right, getting out of what was hot and what was not, I'll take a look at some stocks that you guys are taking a look at. Overreaction on the drop on Tesla. Let's take a look here. Tesla dropping fast there, went towards 179.30s, And let's take a look here. Looks like it's starting to come back here. Definitely looks like it bottomed out around here on the 15 minutes. It's around the 177.50s. You could see that kind of bottoming reversal style action. Now you want to see if also is the market starting to push up, because if the market starts to push up, that's going to help you there in Tesla. And it looks like we are coming back right now. We're just going to have to wait and see on Tesla. One of the things that I think was mentioned on Tesla that scared people was the predecessor, of course, Hoch. And I think that in the long run, I'm really looking to see if we can come back into the 160, 150 range for Tesla. I think it makes sense to go ahead and get it back to where it did the stock split. Of course, the stock split, we're talking about the first one that was in August 31st. If we can get back to that price point, I won't be mad about looking at Tesla. But right now, it needs to kind of hold this 177.50 area. And right now, you're not seeing that complete turnaround. You're seeing it bounce. And if it cracks that, it could crack big. But you could also use it as a risk area, right? Maybe you're using that as your risk area right now, and at least you know you're out on the downside. Such a drama, Tesla OTC recall. Yeah, there's a lot of recalls that have been mentioned, and I think it's just also more concerns about Elon that's been affecting the stock more than Tesla has just been, let's say, falling off the wagon or not being able to meet deliveries. If it was those kind of concerns, yeah, you could state that. One thing to note, though, they do have the semi-truck delivery event that is going to be for them delivering trucks to Pepsi. This is going to come in December, early December. And so I think this could pause a kind of this downturn and give it a little bit of a catalyst run. We'll have to wait and see. I know a lot of people have been waiting to see what happens with Tesla's semi. So wait till you probably hear from that. I think that's going to be a big driver. Now we just need to see how big of a driver it really is. All right, we'll see what else is going on after Tesla. Let's go ahead. 100 semis. It's going to be a lot. I think, one thing that we need to keep watch is that semi truck going to work, right? Is it going to be really effective? Because at the end of the day, 500-mile radius or range with a full load is what I want to be able to see. If that doesn't happen, we'll have to wait and see how these fleet are actually performing for Tesla. OP says Tesla calls for me. Jonathan Lovelace says Tesla puts for me. Well, that's how it is in the market, right? There's always two sides of the coin. And that's what we try to do here on Benzinga. It's about 1:32. In about a couple of minutes, we'll get into the stories of the potential disaster stocks. And at 2 p.m., I got a very short video for you guys to just maybe have some fun this weekend about So Rare, NBA, NFT, fantasy sports. So if you're into the NBA or just like a little fantasy sport action, stick around. That's going to be right after the show, so you don't have to worry. This will redirect you right to that. And it's just about a 2-minute video about undervalued players. And of course, we're going to give you access so that you guys can go ahead and get started with 20 free common cards as So Rare gets you going for free. So it's going to be fun to talk about that. That's coming up. Let's get to some stock action. Looks like a lot of action is going on in certain cryptocurrency stocks, right? Let's go to those stocks and see how they're looking. How are they holding up? Because this could have some more effects, right? That's what I've been paying attention to. Are we going to see continued downside action? I have been seeing more concerns about certain names that I'm going to call out here. So this has nothing to do with even the potential disaster, because it could be even more, right? Mara coming down to 760s. I remember this was a almost $100 stock. It's coming right back down to where it was. And I think eventually it might be going down there towards $5 and below. So be careful on a name like Mara. Just seems like it can't get a grip right now. Let's go towards the ones that I'm really concerned about, which is SI. I've been seeing more and more mentions that this could be a disaster stock also. And so I'm not saying that it's going to go ahead and just completely have that, bankruptcy moment, but I do think that we definitely need to be concerned with stocks like this. Silvergate, MSTR is another one. We've been kind of calling this on the short side. We'll see if it really breaks down. But right now, it doesn't look good there for these companies. I think they're just having extreme exposure, and the situation has really gotten out of hand. Coinbase, right? I mean, what's not to say that Coinbase doesn't go lower from here with all the uncertainty that's out there in these platforms. That's why I feel like Coinbase is trying to make a new low today. The low is 44.62. Right now we're at 44.31, and the low here 40.83. So it looks like we're about to make a new 52-week low in coin. And you know what we say about new 52-week lows? When you see them, we gotta go. So be careful out there. Definitely coin. And it looks like Kathy took a shot on Coinbase and SI. And that really concerns me because I feel like, at some point she needs to start slowing down the risk and focusing on trying not to be as risky on these trades. She added the Tesla and SI and coin. Just shows to me that this is not an area that I want to be, opening myself up to, because it doesn't look like SI has an upside catalyst to it. If anything, it looks like this really broke down, has looked really bad. And if anything, I mean, take a look. This has been going down since August, and it's been a hard downturn. We're talking 75% since August. So Silvergate Capital coming down fast. I remember there was a bank that put out a bearish note on SI. I think it was Bank of America, but definitely it's dangerous. I don't know how she hasn't gone under yet. Who would trust her with their money? It's actually a lot of people, and that's the crazy part. Whatever Kathy buys, short it. Yeah, it seems to me like she's been that type of person that you could make that type of money on. So that's why they had the SARK, right? So who knows? Maybe SARK gets another lift here. So I'm going to keep this in mind here on SARK, but man, what a move there. And I just think that, you got to be careful in names like SI and the cryptocurrency names now. I just wouldn't leave myself up to risk. And there's certain times where I just think that even if there's a good potential reward, is it worth the risk here? I don't think it's worth the risk in SI, but looks like Kathy's ARK Innovation ETF thinks so. So let's get out of that. I will get you guys over now to the story of potential disaster stocks. Of course, now I will go ahead and frame this up. Before I get into this, I'm not saying that these companies are going to go under 100%. Don't want these companies coming back to me and trying to destroy me here. But like always, just trying to show you guys what I see. Like always, there's going to be stories that I'm going to call out a red flag. And it's up to you to do the research and either agree or disagree. I'm not telling you that you have to be following my research. Like always, this isn't financial advice or even educational. Now we're going to get more into entertainment because I'm going to bring you guys a perspective. And I want you guys, of course, to always do your research to either agree or disagree with it. But it's definitely one that could be coming. And there's a lot of concerns out there in different stocks. Let's see if you guys get it right. I'll give you guys a chance here to throw up some companies that you guys think could potentially go to bankruptcy. Go ahead and throw it up. What do you guys think? Maybe some bigger names that you guys think could eventually blow up in this downturn. Go ahead and throw them up. We'll see if anybody gets one of the 2 or 3 companies that I'll talk about. Now, one thing, of course, that I'm going to be talking about is focusing on the stories and the business models. Because really, that's more what I'm calling out here, is the business models themselves. Because business models are what we can call out and kind of really attain ourselves to an understanding of the fundamentals behind the business, right? This is the way that we take a look at certain companies and we focus on their subscription because they're subscription style models. So a lot of times when we're looking into a stock, we need to think about it as what is the business model and does it truly make sense in the current market environment? This is where it's really important because you're going to run into a lot of companies that might make sense in a different environment than what we're in today. And this is what you need to be asking yourself often as an investor. All right, so I see you guys in the chat, and it looks like we do have a couple of winners here. So I'll give you guys a little shout out. I had a feeling you guys would get 1 or 2 right here. So Jay, it's got the first one here. So the first one up is going to be Carvana. I am wishing I will definitely give you a little bit of a uplift there too. And AMC, GME, BTC, no, it actually isn't those, because I think that those will hang around, because at the end of the day, they were out before the pandemic and had their business models way before the pandemic, and they really haven't changed their business models too much on AMC, GME, and Bitcoin. Now, where you're starting to see a change in their business model really was Carvana. Let's go ahead and let's get into it here. CVNA, you guys can see the stock is now down to $7.88. This looks like a little bit of a Mount Everest chart here, but we're going to go into why I feel that this could really be a story of potential disaster. Now, Carvana is announcing today, and I'll give the news that was at least out today, is that Carvana plans to lay off about 1,500 people, or 8% of its workforce, following, of course, the free fall of the company's stock here. Now, these layoffs may impact, of course, Carvana's corporate and tech departments. And then also, of course, they were talking about this, and this was from the CEO, and Garcia was speaking here, and it was stated that, as you know, we made a similar decision to this one in May, and it's fair to ask why this is happening again. Yet I am not sure I can answer it as clearly as you deserve. And what she's talking about here is that they did do some layoffs in May, and now are running into another additional round of layoffs now in November. What? Less than 6 months after that. What are they seeing that maybe they're not letting us in on? Well, a lot of this is probably the model itself. The model itself brings a whole bunch of vehicles under the wraps of selling cars digitally. This sounds great in a pandemic environment, right? Well, in the pandemic environment is really where Carvana started growing massively. This is when we were on this run, right? When we were on this run in 2020, going to 21, this was that big run. This was the run, and what were we thinking here? Well, bunch of cars were going up in value. Used cars were going up in value. What was that doing to Carvana's inventory asset? Well, that was actually causing their inventory assets to go up in value, and they were even able to sell the vehicles at a higher price than what was expected. This is how they really started bringing in the value and also raising the cash flow needed to grab a big inventory. Now, of course, what has changed from 21? What changed from 21 to 22? Well, we were in a state of kind of almost euphoria, where it seemed like no new cars were being able to be put out. Why? New cars were coming out, but the supply was so low that you couldn't even get the new cars if you went to the lot. You would have to wait months and months. So what were people doing? They were going for used cars. And if anything, even dealerships were calling. Dealerships were calling me. They were like, hey, Mitch, do you want to go ahead and sell your RAV4 back to us? Because we'll take it for more than we gave it to you for. They were trying to get the cars back. I think Carvana tried to do the same. And what happened in 21 at the top there in November when we really started topping out? And really, Carvana started topping out right before that in September, actually in August, starting going into October, and then the November kind of hit. What happened there? Well, the Fed started changing the interest rates. And once they started changing the interest rates, this really started hurting the Carvana model. Because once they started changing the interest rates, now it was no longer not only buying a more expensive vehicle, but buying it with high interest rates. Now, of course, this led to the decline that we saw this year. And in the early parts of the year, Carvana was able to hang on. And why were they able to hang on? I think in this box here, well, a lot of this was that the car values still weren't dropping as fast, the used car value. We were still having issues on the lots. Now what's going on? Well, in the recent turn here from summer into where we are now, you're really starting to see some of the supply chain issues with new cars starting to be fulfilled. With that being said, now you have some supply of new cars coming back to the market. And what do you have? Increasing interest rates. This is going to go ahead and hurt what? The used car sales model. Because the used car sales model is getting to the point where now you have high interest rates, higher values, higher interest rates. It just doesn't make sense for the average consumer to be going for those used vehicles now. Now it kind of makes sense to go for the new vehicle. But then when you think about the new vehicle, you're still battling that interest rate. So what ends up happening here is a battle where it's going to create what? Demand destruction. And demand destruction is definitely important because a company like Carvana that's burning through cash needs to do what? They need to continue to just rotate that inventory. There needs to be inventory turnover. If there isn't inventory turnover, then there's all of a sudden these administration costs. There's these updating costs, like, keeping up and mandating of all this inventory isn't cheap. So we're clearly starting to see that Carvana is probably having struggles to meet their numbers that they need to sell by. If not, their inventory costs just starts being too high. So I think you could also see them start going into what? Into liquidating some of their inventory. Because at the end of the day, they're going to probably have too big of an inventory to meet their numbers. Now, where Carvana could run into even more of a battle is that we're now setting more incentives for those EVs. And most people don't buy used EVs. They go for new EVs. And it shows to me that I think that Carvana is just going to have an upward battle for the next maybe 2, 3 years, maybe 4 years until interest rates truly come back down where they could have a supportive environment. So we'll go back to what I talked about, right? So when we think about Carvana, we want to think about the business model. The business model here is to sell used cars and to sell a bunch of them, not just a little bit. And the big part is that they're digital. So they have full exposure to the US. They don't need to be, in Florida and only selling to people in Florida. They sell digitally to everywhere. But they need to sell a high amount of vehicles, I think, to meet their margins that they're looking for. Now, of course, where you're starting to see concerns is when they start cutting in their corporate. They're cutting in their administrative expenses. They're figuring out any way possible to cut on the fat here, cut on the fat there, technology there. Why? Because they don't want to get to the point where their inventory cost is just way too high for the revenue that they're making. And then, of course, the creditors come knocking on the door. We need to continue to see what happens on a company like Carvana. Can it survive? Yes, it could survive. And so I'm not saying that it's a complete disaster here because it could maybe raise some money and get through the survival period. But is it in a mode where it's going to turn around and thrive? I don't think so. So with that being said, I'm a little bit concerned about Carvana. So we'll see what happens with this story. And this story leads us into another story. Yeah. Look no further than the price of the kind of competitors, right? The competitors that came into this shift. Well, another company that could go, right? And when these companies go, they're going to also put pressure on some of these. Look at Vroom, right? Vroom down there toward the dollar, right? Well, these are companies that have shown the same kind of outtrend. And if anything, Carvana hung on for a while, and then we started seeing the true disaster turnaround. All right, well, let's go ahead. Let's get out of Carvana. We'll get into the next disaster stock that could be here. And it all comes down to the famous line that is really, truly going to be, I think, something that's remembered out of this financial time, which is, of course, buy now and pay later. How does this one work? That's really what we're going to see here. If anything, I'm going to call this now. You know how there's a lot of people calling FTX as the next Big Short type of movie. Well, I think this will also be that type of movie here. Buy now, pay later will be definitely that type of movie. And there's a big reason why. Let's start taking a look underneath the hood of this business model. And you guys will see some comparisons to what? Well, exactly what happened in that big shorts, right? With the mortgage industry, with securitization and packaging, financial packaging. Well, this is exactly what Affirm was built on, right? If you think about it, what are they doing? Well, what they do is they go ahead and lend to what? What type of consumer? Well, they're lending to the worst type of consumer, the one that has the riskiest bad credit. And what do these consumer loans consist of? Well, they usually consist of, first 0 APR loans for kind of shorter time frame. But of course, there's some higher interest ones, the higher double rate ones that if you get caught in, you can definitely get, destroyed just by the interest rates themselves. So what does Affirm's model really kind of consist of here? Let's go towards the stock so that we can take a look at the price action. And I've been calling this one since about 40 that it's going to be coming down. And it bounced there. It got up there, but it's back down to $13. Let's talk about Affirm's model here. So really, Affirm's business model is based on the process that they issue loans and then they bundle them in a package and then they sell their loans to a group of investors, what we call securitization. This allows them to, one, not hold the risk on their balance sheet. So you can't see really into their balance sheet and see really what truly is their risk here. Second, increases the volume of loans issued as they reuse the liquidity deprived from the sale of the issues for more loans and repeat. And of course, then they go and package these and send them out. And what do? They, of course, make money on the difference between the interest rates and their margins here. Now, what has happened since Affirm actually started coming out? Well, Affirm really got the nice little big boost in, of course, the 2021 going towards the 22. And I'll show you guys this with this big rise, right? This was the big rise of Affirm. And a lot of people started using it. They started putting it on all the different sites and people started getting it. But what has happened since then? Well, look from 22. What happened there? It's just been on a downward trend. And this is exactly the type of issues. And I agree with Austin. These are the type issues that were brought in the 2008. This almost seems to me like if no one watched the Big Short and read this and was like, okay, well, I mean, fool me once, shame on me. Fool me twice, shame on you. I mean, this is getting to the point that haven't we already learned when we package these up really what ends up happening? And I feel like this is kind of a normal thing because when you're packaging these securitizations, right, you start giving them a rating. But really what ends up happening usually is both sides usually don't really understand the risks that are associated with this. And as interest rates rise, of course, what ends up happening to these margins, they get smaller and smaller and smaller. So if a firm and who they're selling to eventually has to liquidate, what will end up happening is they will not be able to receive those margins. And I think at that point, a firm will be in a kind of a predicament here and will have to usually start liquidating some of these loans another way. I think this is going to maybe in the long run cause a liquidity issue with this business model. Now, there's another company that is in the same boat as a firm. And if you look at this, this is going to be Upstart. And Upstart has also been showing us signs of concern, right? And this really looks like a head and shoulders pattern. If you ever called one and you ever thought of what a head and shoulders pattern looks like, this to me looks like a head and shoulders pattern. But we won't get into that. What we will get into is that a firm is actually in a worse position than Upstart. When I started looking into the research, and you guys can do your deeper research to look into this, is when you look at the kind of leverage and the margins that are available to Upstart in a firm, it's a lot tighter in a firm than it is in Upstart. But that doesn't mean that Upstart is also safe here. It's the same business model. And with this being said, we've seen enough risk come out of the 2008 financial crisis with securitization that I thought that this would be something that at least would be very closely watched to. And I think in this manner, we'll be looking back at a company like Affirm and understand that the buy now and pay later model overall was more than likely misleading some investors and getting them into these kind of loans that once they get caught, they start getting those high double digits APR. They can't catch up to it, but the business model itself is leaving holes for the company to go ahead and continue to come down if they start getting caught in a liquidity issue. So we'll just have to wait and see what happens with these companies. Of course, I've tried to draw the concerns more to the business model than who's leading the company, because that's not my kind of questioning here. You know, my more questioning here is, do these business models leave holes in the business where we could really see some detrimental downside to the point where these companies can disappear? Would love to hear your opinions in the chat. I've been seeing you guys give some conversation. That's what I like to see at the end of the day. Am I 100% that these companies are going down to zero? No, by any means. But there's one thing I like to do, and that's talk about story stocks. And I feel like these stocks were at some point retail favorites and can at some point become really retail disasters. We'll have to wait and see what happens to these companies. Do they bounce back? Can they get back? Carvana, Affirm, and Upstart are going to be those companies that could have that potential disaster. All right, let's get off of that. We're going to get you over towards a little bit more of a positive outlook. Let's go back into the market. Let's take a look about what's going on, seeing if we're getting a little bit of a bounce. All right, let's go towards the kind of 5-minute chart. And unfortunately, I don't got good news for us, team. Looks like we're still on the downturn and rejecting the prior support at using it as resistance here and coming right back down. So it doesn't look good, team. We're right back down there to the 393s. And I mean, this is just a tough market, guys. It looked like we were going to 400 today. And I'm not going to lie, I was a little bit bullish. And sometimes you're going to be right. Sometimes you're going to be wrong. And at this point, I can say I was wrong on the day, that's for sure. But like always, got to know your risk spots. And I was able to get out on my risk today. And that's what really matters in trading. Like always, you're never going to be 100% right. All you can do is try to be in the mathematical advantage. All right, catching up with the chat. What's going on out there, Antonio? Appreciate the love from Sacramento. How are the Sacramento Kings doing? I've been seeing Fox ball out there, Antonio. Evie, Michael Burry warned recently that the next crisis would come from a consumer credit crunch. Well, that definitely could be showing up. We've been seeing credit cards jumping like crazy. We'll have to wait and see. Shout out to the Story Investors. Yes, definitely. Story Investors is what it's all about. And investing in Story is one of my favorite things, really, because when you can find a story that you can really attach yourself to, and then look underneath the hood to see that the business model makes sense, those are my favorite types of plays. So always look into that kind of outlook. What's the story? What's the fundamentals? What are the technicals? What, of course, makes sense here for the business model. All right, we'll keep going. We'll take a look. Mike Burry is in Geo. Isn't that prison? We'll have to wait and see. Would you take a 20% loss on Tesla long-term if it looked like it was going down? Not asking for financial advice, just if it's wise to do that. Well, the truth is if you're getting kind of 20% losses, then maybe you're opening yourself up to bigger losses than you really expect. And I think that at some point you need to be looking back at yourself and saying, well, how's my strategy outlook, right? I'm not saying that you should take that 20% loss in Tesla, but another thing is take a look. Do you really want to be having these high kind of percentage returns and also high, low percentage, well, high losses, right? And then, so the big thing is this gives us huge waves in our equity wave. And a lot of times we want to be slowing this wave down. Not saying that this is specifically to your kind of portfolio, but one thing that I noticed is that I don't want my account going down 20% and then up 20%, then down 20%. I would much rather have a kind of steady up climb on my equity curve than be having those big dips and rips, because those are what truly drive our emotions to the point where we can fall off the wagon. And then next thing you know, we're not in the zone, not focusing on our mental reward and our profit to loss ratio. And we give up the mathematical advantage. You guys hear me talk about it often. Mathematical probability in your favor. Once you ruin it, it really ruins the way that you trade. Because if you trade to a specific process, the moment that you make even just one trade off of that process, you can very easily start ruining what was your profit to loss ratio and your expected return. This is what we don't want to be ruining, that expected return, because we're trying to be objective here and not subjective, changing that risk on each trade so that we can stay in some type of mathematical responsibility towards the probability to being in the green. What do I mean by that? Let's say as simple as, trying to go for 2-to-1 trades. And that means that I can be, 50% accurate to break even, or maybe closer towards 60, 70% accurate to get into the green. It all matters. And it's definitely something that I pay closely attention to. And how do I do that? Is taking data. That's what I recommend for you out there. If you're looking at how do you start getting into the edge? Well, take a lot of data, understanding your process, different patterns, and writing down when they're working, when they're not, because this can give you that ability to have different tools in the tool belt. But I'm going to get you guys over to, of course, So Rare coming up next, NBA action. Check it out, team. Check out the episode right here. This is undervalued players for NBA So Rare. You don't got to go anywhere, team. And then I'll see you at 3:30 with Joel Alconin as we review the overall market action. Let's get you over right now towards that So Rare. And if you guys like NBA or like maybe some fantasy sports, check this out.